The market has definitely run out of patience.
So there's going to be greater scrutiny.
In the near term, the demand is still there. You're seeing adoption rates increase.
The micro is the macro. AI in the markets, it is the dominant feature.
This is kind of where the rubber hits the road.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, equities pushing higher. Wall Street returning from a long weekend, adding to last week's advance as the softer than expected jobs report is removing some urgency to hike. Just days before, SK Hynix is tapping US equity markets for $28 billion. That's a big highlight of the week ahead in what could be the biggest ever first-time share sale by a foreign company. That listing on the Nasdaq expected on Friday. Before that, we'll be getting a major test for the chips trade. Quarterly earnings from Samsung dropping tomorrow with high expectations and very little room for error. That's coming up later this week. Here's what's coming up this hour. Alex Altmann of Barclays as tech drives equity markets higher. Tobin of Wolfe Research as President Trump heads to the NATO summit in Turkey. And Kunst of Cleo Capital with SK Hynix closing in on its US listing. We begin this hour with stocks grinding higher as tech regains momentum. Alex Altmann of Barclays writing, cast aside your fundamental view for the time being because this market is back deep in technical territory. Alex joins us now for more. Alex, good morning.
Good morning.
Just breathe some life into that quote, if you can, buddy. What do you mean by that?
So, look, obviously, when people talk about equity markets, they talk about the fundamentals, they talk about earnings, and yes, that's all been pretty good, and also the economic backdrop has been robust. We've really been focused on the technical aspect for several weeks now, and really at the centre of that is what's happened within the levered ETF community. We've talked about that in the past, but the plain, simple aspect of levered ETFs is that you've got a huge amount of sort of short gamma within the market, and what I mean by that is that when stocks have been going up, particularly in the tech space, and in the semi space, it's driving more buying in that, from a technical aspect. And if that goes into reverse, we could see that spiral downwards as well.
How concentrated are some of these concerns in one particular region, in South Korea?
Loaded question there, John. So, yeah, it's very much within South Korea. And we are particularly concerned about that because the concentration AUM growth within that region has been prolific. So we've effectively seen that go from around about 12 billion AUM in February of this year. And that's now grown to about 50 billion. But also, if you look at the underlying share turnover of SK Hynix and Samsung as a percentage of that's driven by the levered ETF, we're talking about potentially 70, 80, 90% on a daily basis has been driven by that technical flow. So again, you've effectively moved from just a pure speculation and investment into, dare I say, a bit of gambling.
And we've got to acknowledge this, that we're talking about a week ahead in America, here stateside. We're both Brits and we've lived here for quite a while. We don't typically start a week ahead by talking about two South Korean names, Samsung and SK Hynix. Quarterly earnings from Samsung and an ADR listing from SK Hynix. How unusual is that to just look to two South Korean names to set the tone for the US equity market?
I would say from a South Korean into the US equity market, I personally would describe it as something I've never seen in my career. Maybe we saw that in Japan back in the 80s during the go-go years then, but I certainly don't remember it. The closest I can ever remember was when Nokia was really dominating that debate with their sort of 11 a.m. in London time releases, which they obviously moved specifically so they could capture the US market. So we haven't seen anything like this in a very long time, dare I say, ever.
Futures this morning, positive by 0.5% on the S&P, some outperformance on the Nasdaq. Alex is going to be sticking with us through the hour. Max Kettner of HSBC, constructive and with this to say, we remain undeterred in our pro-risk bullish stance despite recent scepticism towards the AI narrative. Max joins us now for more. Max, forever bullish. I've got to start by asking, is there anything that you're seeing on the supply side of both debt and equity, particularly given the share sale later this week from SK Hynix, that would offer a headwind to your constructive view?
No, not yet. I think particularly from a technical, from a sentiment and positioning perspective, all of our stuff is pretty much still in neutral territory. Our stuff on long-only positionings or long-only investors, they're a bit more overweight equities, however underweight in high-yield credit. So I think the overall beta actually in terms of overall risk assets, still quite low. Nothing really that is, or would compare it to 2021, where really it's been exuberant in terms of positioning, particularly among the long-only community, so we're very far away from that. All of the other stuff that we track, the discretionary and systematic shorter-term positioning indicators, they're all around neutral. There's no real buy, no real sell signal, so nothing really to worry about that. Now, on the supply side of things, we talk obviously a lot about IPOs. We talk about Hynix, of course, as well. But when we look also at the debt side of things, right, there's been lots and lots of worries about debt issuance from the hyperscalers, from the AI names. However, when you look within tech, when you look within investment-grade credit, within investment-grade credit in the US, tech is only about 10% of investment-grade credit. You look year-to-date at the issuance, it feels like all of the issuance has come from tech and from hyperscalers. In reality, that's been less than 20% of issuance. In reality, net supply overall looks much less worrisome because financials, insurers and banks have actually brought down net issuance. So overall, I think, particularly also from a debt perspective, the narrative is very, very different from when you look at the numbers. The numbers, particularly on the debt supply side of things, don't really look that worrisome at all.
Max, you mentioned some of the companies doing all the spending, and clearly there's been some big beneficiaries of that, the semis. Last week was interesting. And there is a question this morning as to whether it's the start of a sustainable rotation back towards the big spenders and away from the beneficiaries, with Meta at the epicenter of that. Meta up last week on our report here at Bloomberg that they'd be looking to sell out excess capacity and maybe start a sequence of events that might lead to some discipline for the hyperscalers that would lead to some underperformance for the semis. Max, what do you make of the start of a potential rotation back to the big spenders and away from the beneficiaries?
Yeah, I think that makes sense. It's probably not just, or not a full-on rotation where you'd basically use the AI names or the memory names as a funder to buy the hyperscalers, but the hyperscalers going into a full-on bear market in May and June, going down 20%, that really is too much. I think now in the reporting season, what if, for example, we actually in the next few weeks, we find out that hyperscalers, yes, they are still really investing all this money. They're still undeterred in their capex plans, but at the same time, they are still making a lot of money. They're still really making a lot of profits. Plus, perhaps we're already starting to see more evidence on monetizing those AI capex as well. That, of course, would be a very welcome surprise. What I would also say is, given that drawdown in the hyperscalers, the expectations now are much lower. We're starting from a much lower base, right? You look at quarter-over-quarter earnings growth within the entire S&P. You strip out, for example, materials and energy. Actually, consensus estimates for net income are -3% quarter-over-quarter. The year-over-year rate is probably a bit misleading because we had this great earnings season in Q1 with this almost 20% average surprise factor on the earnings side. But when you look at the sequential, you look at the quarter-over-quarter net income, you strip out materials and energy, you strip out these oil price effects that we've undoubtedly had in Q2, that actually the expectations aren't exuberant at all. So I do worry that people once again are too neutral, a little bit too much on the sidelines, too worried about things going wrong. And actually, we are getting a bit of a summer melt-up into July and August.
Max, we obviously had an at-the-money offering from one large hyperscaler, and there's concerns that the rest will follow just because the equity risk premium is now negative, so it makes sense then for them to tap the equity channel. How do you feel about that?
Yeah, overall, I'm not particularly worried, to be honest, because this whole equity versus debt, I mean, let's be honest, when you look at equity offerings overall, yes, the dollar amounts sound very high. We know that the free float, obviously, is a very different number than the total market cap. That's number one. Number two is, when you look at the dollar amounts even of free float or the IPO that's coming to market, the IPOs that are coming to market this year, plus the equity offerings, in terms of market cap, you're probably more on par with 2020, not with 2021, and you're probably even a bit lower than in 2020. And let's remember, in 2020 and 2021, when you compare this to now, when people say, oh my God, we're in an earnings bubble and it's all just AI and it's tech and it's exuberance, let's remember what we did in 2020 and 2021. We threw money behind SPACs. We literally threw money behind companies where people said, well, I don't really know what I'm going to invest in. I don't know when I'm going to do it. But you know what? Just give me some money and I'll figure it out. And really, we call this a bubble where we do see these crazy, crazy margins. These crazy margins, look at Micron 2 weeks ago, and we compare that really and call this more of a bubble, or even a bubble, than what we had in 2020 and with 2021. I think that was really way more exuberant, paired also with much more exuberant positioning, both on the systematic and the discretionary side. So overall, yeah, I can't really get myself too worried about that.
So, Max, not for me to say if it's a bubble or not. That's your job. You're in that seat. I'm not a technologist either, but I do look at market signal. And the market's sending a pretty obvious signal, at least from my perspective, to one single name. If you go back a month to the start of June, when we had that FT article that reported that Meta was considering a capital raise, equity, that stock sold off. A month later, we have a Bloomberg story and they're considering selling excess capacity. That stock rallied. Doesn't the C-suite have to sit up and take notice of those kind of signals coming from financial markets?
Yeah, and therefore it probably makes sense to go a bit broader in your particular in your US equity exposure, and not just by the memory and the semi names, right? We are still going to face that shortage probably well into the next year and a half. But is that really the only game in town anymore? No, it's not. That really was the story in April and in May. When you looked at what happened since the end of March, that was when the semi-names, the tech and AI names really within the S&P went up almost 50%, and the rest of the market went actually down 10% and only recovered half of its drawdown from the Middle East conflict. We've just now, in the last 2 weeks, went above that watermark. So they're now flat. The rest of that S&P, outside of those semi, outside of those AI infrastructure complex, they're just above 100 now. They're just back to where they were at the end of February. And that's the stuff that I think you want to lean into, play a bit more the broadening and actually play that it's not just semis, it's not just that AI infrastructure universe that's doing well. It's actually the median company. Look at median earnings, for example, the last two earnings season, not only in the US, look at Europe, you look at Japan, you look at EM. It's everywhere where in the last two reporting seasons, really, median earnings growth has gone up and median earnings surprises have gone up. So it is more of a broad-based fundamental story.
The good news as well, just to jump in for the broader story, is that the rate story is stabilised too. Data was a bit softer than expected on Thursday. Crude's lower this morning, back to 68 on WTI. Brent crude back to 71. Max, do you believe we have removed some of the urgency to do something at the Federal Reserve?
Oh, yeah, absolutely. I think that whole story around Kevin Walsh being the big hawk and us as markets now having to finally price some data and not only rely on the Fed to give us forward guidance. To be quite frank, I mean, I sat there in the press conference and I thought, what the heck have we done so far in the last 15 years? Really? Did we only just wake up like 1 hour every 3 months, look at the dots and then go back to sleep? Really? I mean, this is a slightly bizarre take from the market, I think, to read so much into what Kevin Walsh was saying and how hawkish he was. Remember the first press conference, he said, the 2% target, the 2% inflation target is not up for debate for now. How is that so hawkish? So I think that whole hawkish narrative was too much narrative, not enough backed by the data. And let's remember, when you look at activity surprises, just look at US against Eurozone activity surprises, you really had the third biggest divergence, the third biggest outperformance of US surprises in the last 10 years. So I do wonder now, going into the second half, how much further can that go? That US exceptionalism, that's really making its way into consensus. That was very different 3-4 months ago. If you said, look, no, the US, I know there is geopolitics going on, but the US domestically is doing so fantastically well. That was out of consensus. That was raising eyebrows. Now, if you say US exceptionalism, I mean, your meeting with clients is done after 10 seconds because everyone agrees. Yeah. So I do wonder, really, rates, perhaps both front end and long end coming down, that should help also multiples to recover.
Max Kettner of HSBC. Max, appreciate it, buddy. Thank you, as always. The rate story stabilising around 4.1% at the front end of the curve on twos. Crude lower again this morning on Brent and WTI. Alex, jobs just a little softer than expected on Thursday. Difficult to make too much of a big deal of that, really, to be honest with you, because still north of 100 count a 3-month average. Unemployment around 4.2%. It's difficult to worry about the US economic backdrop. based on data like that.
Yeah, I agree. I don't really think there's an enormous amount from, again, the fundamental picture of the equity market, I think right now is in relatively rudimentary health. And I actually agree with Max. I don't think we've necessarily seen anything particularly dramatic from the new Fed chair, other than effectively reiterating one side of the mandate of the Fed rather than the other, because I think, quite frankly, the other side he's not enormously worried about.
Futures this morning up 0.5%. Yields at the front end of the curve down 3. Twos at 4.1%. Alex is going to stick with us through the hour. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. SK Hynix gearing up for what could be the biggest ever first-time share sale by a foreign company. The South Korean memory giant expected to list on the Nasdaq this Friday, raising about $28 billion. Hynix's core valuation is likely to depend on memory demand, AI spending, and Korean macro conditions. Oil continues to flow through the Strait of Hormuz as OPEC Plus signals higher supplies. Members of the group backed another modest rise in quotas for next month, with 7 nations agreeing to add 188,000 barrels a day. Saudi Arabia, the UAE, and other producers are set to release official selling prices this week. FIFA reversing that red card against US star Folarin Balogun, allowing him to play in tonight's World Cup match against Belgium. The move comes following a personal appeal by President Donald Trump. The president posting on Truth Social, thanking FIFA for, quote, reversing a great injustice. Belgium is set to appeal the decision. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Tells you a little something about how focused people are in this market this morning. The most read story on the Bloomberg terminal this morning is this one right here. UEFA, the European governing body, weighing in just moments ago saying FIFA's reversal of the Balogun red card crossed the line. The regulations cannot be made subject to exceptions. Alex, what do you make of this one?
I think it's been the 4th of July weekend and people are slow to get back into financial markets, John.
That's what it feels like. People were up late last night too, watching the England game as well. My opinion is as follows. I didn't like the red card to begin with, so let's focus on the substance. I don't like when they reduce the replay to several frames and go through ultra slow motion. Hate it. So please, it's been corrected. The optics of it stink. And that's going to be the problem for FIFA from here. Whether this is just a one-off exception or whether they look at the other red cards, if they're coming, and do the same thing. We'll no doubt have more to say on this through the hour on this programme. Up next on the programme, a major test for NATO.
We're very disappointed with NATO because NATO has done absolutely nothing.
They don't want to help us defend the strait, and they're the ones that need it.
I'm very disappointed in NATO. We pay trillions of dollars for NATO, and they weren't there for us.
Tobin Marcus of Wolfe Research joins us next, live from New York City this morning. Good morning. Equity futures adding some weight to the rally this morning, higher by 0.5% on the S&P, on the Nasdaq up by 1.1%. Last week, the biggest weekly gain on the S&P 500 in about a month, advancing almost across the board. In the bond market, softer than expected jobs data on Thursday. The payrolls report just a bit weaker at the headline. Unemployment back to 4.2%, though, catches your eye. The 2-year yields dropping on Thursday again this morning at the front end of the curve. We're down by 3 basis points, 4.1%. In addition to that move, the data in America just a bit softer than expected. More data later, of course. PMIs and ISMs. But also the move in crude, helping this move in bonds as well. WTI and Brent crude down by 0.75% this morning. Brent at 71, WTI around 68. And the surveillance this morning, a major test for NATO.
We're very disappointed with NATO because NATO has done absolutely nothing.
We don't need them, but they should have been there.
They don't want to help us defend the strait, and they're the ones that need it.
We'll come to their rescue, but they will never come to ours.
I'm very disappointed in NATO. We pay trillions of dollars for NATO, and they weren't there for us.
So here's the latest this morning. President Trump gearing up for the NATO summit tomorrow in Turkey as the administration pushes the alliance to boost their defense spending once again. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John, good morning. Well, as President Trump renews his threats against the alliance, we just had the NATO Secretary General Mark Rutte here in Washington late last month in a bid to try to smooth ties ahead of the summit this week. He pointed out what has been a relatively sizable increase among defense spending for European governments, though our analysts at Bloomberg Economics say not all countries are likely to meet that 3.5% of GDP goal, let alone the broader 5% overall goal that this White House has been pushing. That is going to increase the pressure over the gathering this week, though some other countries may try to court the White House's favor in some other ways, as the German chancellor is reportedly seeking a joint weapons production agreement with U.S. defense companies. Now, the rifts between the alliance has only really been heightened amid the conflict with Iran, though we do know that our allies are hoping that now this more perhaps durable ceasefire is in place, we could see some renewed focus when it comes to Ukraine. The White House has confirmed that President Trump will hold a bilateral meeting with his Ukrainian counterpart Zelensky later this week, after he just held a phone call with Russian President Vladimir Putin on Saturday. Now, John, a senior U.S. official who briefed us reporters ahead of the president's travel this week, says that the White House's position is that it doesn't feel that either side is really making progress when it comes to the conflict, and that President Trump will push the Ukrainian president on what Ukraine can do in order to end the war.
It's notable that the world seems more obsessed with the red card being withdrawn, and maybe not the focus on this at the moment. Tyler Kendall down in Washington. Tyler, thank you. Tobin Marcus of Wolfe Research writing the following: we remain sceptical that there is any realistic path to a big structural increase in defence funding. Tobin joins us now for more. Tobin, welcome. What's achievable over the next few days?
Thanks for having me. I'm not expecting a lot of big outcomes out of this summit. It's been positioned as kind of focused on implementation of commitments previously made. I think from the European side, they're going to be trying to manage tensions, prevent anything from going further south after the outbreak of frustration on the U.S. side about the war in Iran. But, I think the hope will be that as that war is winding down, really what we saw over the course of the past few months, and you had it in those clips, is sort of the president lashing out at his frustration about how the war is going, rather than really expecting that there was something the Europeans could do on their own to reopen the Strait of Hormuz. So now that that's taken care of, perhaps that point of tension is off the table.
Do you think one war, though, informs another? Tobin, do you think there is real fallout from how things have played out in the Middle East in the last few months that shaped the approach of the US to the war in Ukraine?
I think that, to your point, that the sort of American viewing audience seems more focused on the World Cup than they do on the war in Ukraine. I think that, frankly, is going to play into the extent to which President Trump feels compelled to resolve this. He obviously came into office with a very optimistic view of how quickly he could bring the war in Ukraine to a close by putting pressure on both sides. That hasn't materialized. And I think that in the absence of really specific focus from U.S. voters, it's the kind of thing that he could take or leave. I think he would like to wrap it up. But if he thinks that both sides are, that they have intractable war aims and aren't willing to hang it up, and also that no one's making progress on the battlefield, I don't know that that has to be at the top of his priority.
Tobin, it begs the question, though. He pursued a war in the Middle East that was deeply unpopular in this country anyway, and carried on with that. How important is the public opinion to the president in his last term?
Yeah, I certainly don't think it restrains him materially on most of his agenda. There's all kinds of things he's done that are not what voters sent him there to do. I think even before the war in Iran, voters had a sense of misplaced priorities. Not that they, hated the tariff campaign so much, but it certainly was not reducing prices, which is what he had been elected to do. And then certainly nobody asked for the war in Iran, and we saw that reflected in President Trump's approval ratings. So where he thinks something is important and where he thinks it's tractable, he's perfectly capable of focusing on areas that voters are not themselves focused on. But if he doesn't think it's tractable, I just don't think that he has all that much appetite to bang his head against the wall of the Russia-Ukraine conflict if he's not able to get the two sides to do anything differently, as he has not been so far.
Tobin, how does that set up Republicans going into the midterms just several months away?
Yeah, I think the outlook looks not great for Republicans. I think the overall national environment certainly looks like it's going to be quite blue. I think that in the House, the sort of left-leaning national environment is going to be more than enough to overcome the net Republican gains in redistricting, which they will end up ahead, somewhere in the neighborhood of 8 seats. In the Senate, there are a lot of close races, but I do still think that leans towards Republicans. Democrats need to, do some challenging, win some tough races in Maine and Michigan before they even get to these kind of reach seats they need to win in states like Alaska or Ohio. So, they really need everything to go right Republicans only need one or two things to break their way in a couple of red-leaning states.
November still feels like a long way away. Tobin is going to catch up, as always. Tobin Marcus of Wolfe Research. Annmarie on the ground over the next couple of days in Turkey at the NATO summit. So look out for interviews from her over the next few days right here on Bloomberg TV. Coming up next on the programme, we'll catch up with Sarah Kunst of Cleo Capital as SK Hynix prepares for its US listing. Plus, Yahira has your morning movers. Memory stocks gaining ahead of two new tests for the tech trade through this week. The listing from SK Hynix later this week, and earnings from Samsung. Quarterly numbers from Samsung coming up tomorrow. From New York City, you're watching Bloomberg TV. Returning from the long weekend with equities positive by about 0.5% on the S&P, at 1 percentage point on the Nasdaq. This from John Stolfus of Oppenheimer this morning. From our position on the radar screen, our year-end price target for the S&P of 8100, which we initiated back in December, that's a flex, looks reachable from here. The Nasdaq up 1%. Futures on the S&P up by 0.5. In the bond market, helping this move, yields starting to behave at the front end of the curve, down another 3 basis points on twos at 4.1%. Talked about the softer data on Thursday, softer than expected. Not soft overall, but just a bit weaker at the headline on the jobs report on Thursday, unlocking a move lower at the front end of the yield curve. Yields down. Thursday down again this morning. This Monday morning we're down 3. Moving crude helps that on both WTI and Brent. Over in Japan, Japanese yields on a 10-year, the highest since '96. Dollar yen up another 0.6%, 162. Goldman was catching up with the team in Europe a little bit earlier this morning. Over in London, Goldman looking for 165, which, let's face it, is about 5 minutes away based on some of the price action we've seen. 162 this morning. The prospect of hitting 165. Alex Altmann with me out of Barclays this morning. Alex, what kind of a problem is brewing over in Japan right now? Higher yields, higher since '96. It can't buy you some yen strength.
No, it can't, and that is why you're getting the central bankers be getting more aggressive on their rhetoric. I mean, we saw the New York Fed check at the beginning of the year, and then we saw the direct intervention after that, and then effectively now you've got the market speculating we're going to get even more. And I think that the problem is right now is that unless you're going to actually indicate a more aggressive monetary policy stance, then effectively macro traders see this as another funding trade, despite the fact that the terms of trade with Japan have actually improved.
Dollar yen this morning, 162 and higher by 0.6%. We'll come back to that a little bit later. As we cut it down to the open, about 3 hours away from the cash open, let's get to your morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing the memory trade rebounding this morning with names like Micron and SanDisk up after selling off in the last session on Thursday as optimism builds around two major events this week that you've already mentioned. We get Samsung earnings tomorrow, plus SK Hynix plans to list on the Nasdaq on Friday. And this is coming at a pivotal time as investors look for fresh confirmation that demand for AI memory chips remains strong, especially after our reporting last week that Meta is looking to sell computing power, and that raising some questions about the demand picture. Speaking of Meta, we are seeing those shares outperforming the Mag 7, up just 1.7% this morning. And while there's no company-specific news, we did get a call from Mike Wilson over at Morgan Stanley, who will be joining the program later, on the hyperscalers, saying that he prefers them over semiconductor stocks as a better way to play the AI trade because of their strong underlying businesses. He also expects the hyperscalers to strike a more measured tone when it comes to their AI spending plans, as investors increasingly want proof that those investments are paying off. So that may help the rotation take place. And we end on Alibaba, those shares also rising in the pre-market, up 1.5% after a judge granted the company temporary relief when it comes to its blacklist by the Pentagon. For now, Alibaba can continue to work with Washington lobbyists as the court considers its challenge. Remember, the Pentagon added Alibaba to its blacklist last month, citing alleged ties to the Chinese military, something that the company strongly denies. John.
Hey, Yahira, thank you. More from Yahira in the next hour. Yahira mentioning Morgan Stanley's Mike Wilson. Mike's going to join us in about 30 minutes' time, so look out for that. On our radar this morning, NVIDIA's next-generation AI server reportedly facing delays of more than a year due to manufacturing issues. The report sending Asian tech stocks lower, with investors already on edge over disruptions to the AI trade. Elsewhere, SK Hynix gearing up for what could be the biggest ever first-time share sale by a foreign company. The South Korean memory giant expected to list on the Nasdaq this Friday, raising about $28 billion. And FIFA overturning the suspension of the US top scorer Florian Balogun. The Wall Street Journal reporting President Trump weighed a legal challenge to FIFA's use of slow motion replay to assign him a red card. It's FIFA's first such reversal in more than 6 decades. If you're looking for an energetic handoff from the team in London to New York later on this morning, Alex Altmann, I imagine you're not going to get it because most of London was up late last night watching the game.
And not just that game. Obviously, there would have been on tenterhooks looking at the Norway-Brazil game as well to see who they were going to be playing in the next round of
Is it coming home?
I don't think I can say that on live television.
OK. I don't want to wide that. There's going to be some tough games ahead. That's for sure. Stocks are positive then, up 0.5%. We've talked a lot about the memory trade. Another big test coming later this week with Wall Street looking to Korea, with Samsung results on deck and SK Hynix preparing for a US listing this Friday. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome. Alex and I were talking about this 30 minutes ago. It's really peculiar to sit here and to look to South Korea to set the tone for the US equity market. But Mandeep, I guess that's what we're doing for the week ahead.
Yeah, and that's where the earnings growth is. So look, when it comes to SK Hynix, this is a company that continues to show, triple-digit earnings growth, partly because the trends are in their favor. And they've been very disciplined with their CapEx. So I know everyone is looking for the end of memory cycle, but the way these companies, the 3 companies on the memory side have gone about the supply expansion, they've been very disciplined. And that's where if, the next version of NVIDIA chips is going to have 3 times more HBM needs, then clearly with the supply expansion that we have seen so far, you will continue to see steady price increases. And I think that's what you will find out in SK Hynix results, the price increases that we have seen, so far.
Mandeep, for anyone waking up this morning and looking at the reduction in the deal size from 29 to 28, what's behind that? How much of a big deal should we make of that?
Not much. I think, there will be some nervousness around buying, a memory company and getting that allocation in terms of if you're playing this for a secular trend, is memory the right place, a company like SK Hynix? But to my mind, everyone seems to be underestimating how much memory we would need. And we have already seen Apple raising prices. So when you look at the trends, they may last longer in terms of their durability. But look, this is a cyclical industry, and that's where there will be some nervousness around any new IPO.
Mandeep, no doubt we'll catch up tomorrow as well. Earnings from Samsung just around the corner. A US listing from Hynix later on this week. Mandeep Singh there of Bloomberg Intelligence. Sarah Kunst of Cleo Capital writing the following. Will there likely be appetite for SK Hynix to list in the US? Certainly. Will the price be reasonable and reflect the business fundamentals and looming AI bubble risk? I highly doubt it. Sarah joins us now for more. Sarah, let's build on that last line. Why do you believe that's the case?
I think that right now people feel like any exposure they can get to the AI trade still is going to work. And the thing that I really don't like about it is that we're actually seeing retail investors in Korea rush in to names like SK Hynix at sometimes insane up to 150x leverage, while we see sort of institutional investors mainly flow out. And that is generally not a sign of a company that is super well priced and likely to continue to make a lot of more money for investors.
Sarah, on that exact point, obviously we've talked a lot about levered ETFs and how there's a concentration within the Korean market. Is there a risk that you actually see money getting pulled out of those levered ETFs and get allocated back into the ADR listing when it comes this week?
I certainly think so. I mean, it makes a lot more sense to just own the asset versus owning an esoteric ETF that flows through a sort of illegal Binance account in South Korea, right? Which is what we're seeing a lot right there. And so I think this IPO will do well. I don't know if the IPO doing well is the best signal of the health of the market, sort of conversely.
And then if you actually sort of think about the relative valuation between, say, SK Hynix and some of the local peers, a lot of the ADR, reason that people wanted to get into the ADR was specifically for that valuation differential. Is it still as wide today as after the rally that we've seen?
It's shrinking, but I think that what most investors are looking at is the gap between where the U.S. companies that are in similar lines of business trade and where these names do. And that gap is definitely still there. The real question you have to ask is the U.S. stock market right with our ever increasing multiples? And is the rest of the sort of global stock markets wrong with their much lower multiples? And if you think that, hey, maybe the U.S. stock market is widely overvalued, especially some of these hyperscaler names, then closing that gap doesn't necessarily make you money long term.
Sarah, just build on that again. You said looming AI bubble risk in the quote that I shared. Then you said ever increasing multiples. Where are you seeing that?
I mean, I think SpaceX, Palantir, right, Tesla, you look at those triple digit kind of PE ratios, if they even have them, right, if they're even profitable, that is not sort of a sane, solid, great place to put a bunch of money and hope that all goes well indefinitely. I do think there are names that are relatively right-size valued, maybe, the Alphabets, the Metas, but the funny thing is those are actually names that people are increasingly nervous about, skeptical about, even souring on. And that's why you're getting these reasonable valuations, because people are almost fully negative on them.
Do you think we're about to see a strategic pivot from the likes of Meta?
I think that Meta is learning faster this time. Zuck is learning faster. So if you remember back to the legless metaverse, the stock just plunged and plunged, and that man did not care. He was going to make the metaverse happen until it finally didn't. I think this time, you know, we have reporting this weekend that there have been leaks of documents where he basically says, yeah, guys, the layoffs were a mess. The AI sort of pivot in general has really been tough. We have not done a good job. We know that other senior figures like Boz inside of the company are saying that. So it does seem like this time they are much quicker to say sort of, we've messed up. Let's try to fix this. I think the cloud computing thing is a good sign overall, that he's not sort of saying, I am going to put all of your money into a bonfire and burn it at the altar of AI CapEx no matter what. He is willing to say, if this doesn't work super well, here are some, you know, ways to let a little steam out and to get some cash back in. I like that. I want to see him be ambitious while also paying at least a little bit of attention to shareholders.
The stock seems to like it too, based on the initial reaction to that news from just last week. Sarah, do you think we're learning something just about Meta or the broader AI trade?
I think the broader AI trade, the question here, right? We all know the obvious questions. How much actual sort of demand is there going to be? How much money are people going to pay, you know, the open AIs of the world for access to these AI models? Those are the big questions. I think that in the second half of this year, there's going to be a sort of smaller, more persistent question, which is if we right size this trade, which I think we're on track to do, I think we're going to see some of these valuations get smaller. I think we're going to see some of these IPOs get smaller. How do we do that without sort of punishing everybody and wiping out some of these big names like the Alphabets, like the Metas, even like the SK Hynixes that have really solid core businesses that existed long before AI, will exist long after this current moment? And how do we not sort of confuse those two?
Sarah Kunz, the Cleo Capital. Sarah, appreciate it. Thank you. Big changes potentially. Changes in the language we're using to talk about this trade. We've gone from talking about scarcity, supply constraints, bottlenecks, those kind of things, and now we're talking about excess and selling excess capacity at Meta. What did you learn from that reporting last week? Something about that stock, that particular name, or something more broader?
I learned something more broader, and I think what I think is that the market needs to think about, do you want to be short human ingenuity? We have a series of problems as a society when approaching AI. And right now, Wall Street is looking at it as a linear extrapolation to solve those problems. We just need more compute, we need more memory, we need more power. But actually, if you think about the efficiency gains that we'll probably get along the way, over the next several years as we improve chips and so on and so forth, then are we going to end up with excess capacity down the line? And actually these businesses that are growing data centers the size of Manhattan, they're going to start selling it back to other parts. So I don't think there's an issue with demand. I just think it's more of a case of if you have a linear extrapolation of what the current trend looks like, you're shorting human ingenuity to solve these problems.
Do you think we're closer to that moment than maybe some people believe?
I think that it requires very small changes in narrative to have a disproportionate change in price right now as a function of all of that technical market setup that we've talked about.
This is the price of the story this morning. The Nasdaq up by about 1% this morning, and the S&P up by 0.5. With an update on stories worldwide, with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Russia launching a barrage of missiles and drones at Kyiv overnight, killing at least 20 people and exposing a growing gap in Ukraine's air defences. With the strikes coming ahead of the NATO summit, where Volodymyr Zelensky is expected to press Washington for more weapons. Shares of EasyJet soaring in UK trading. The budget airline agreeing to a takeover bid of about $7 billion from US firm Castle Lake. The two sides have gone back and forth over the possible deal in the past month. The agreement still faces scrutiny from shareholders and from regulators. One of President Trump's signature initiatives took effect over the weekend. Parents can now start contributing to newly launched Trump accounts, which provide a $1,000 government-funded investment for eligible children born between 2025 and 2028. And that is your Bloomberg brief. John.
Very cool. Vonnie, thank you. Thank you for the update. Up next on the programme, the OK economy.
You've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. That's part of why I don't really understand, significant raises in interest rates relative to this.
Kelsey Berro of JPMorgan Asset Management joins us next, live from New York City. You're watching Bloomberg TV. Equities this morning positive by 0.4% on the S&P, on the Nasdaq up by 1%, returning from the long weekend stateside, adding some weight to a rally in this equity market. Big week of gains last week, the biggest going back to May. If you switch on the board and get to the bond market, 2s, 10s and 30s, let's just isolate the front end of the curve and talk about 2s. Down again this morning, yields lower by 3 basis points, 4.1%. Two very different ways to look at the same labour market report. This from Bank of America. No major fireworks. The data was soft on balance, but not as dovish as the market reaction suggests. We maintain our 3-hike call. That's Bank of America. Here's Citi. Soft job growth in June. Downward revisions to prior months will relieve hawkish concerns. Any case for hikes is disappearing. They're looking for rate cuts to start in October. That's the divide on Wall Street right now. Bank of America on the one side, looking for hikes. Citi on the other, looking for cuts. Under surveillance this morning, it's an OK labour market.
Listen, I think that the hiring in the country is just okay. It's stable, it's okay, but you've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. That's part of why I don't really understand, significant raises in interest rates relative to this.
So here's the latest this morning. Investors are waiting fresh data for insight into the true health of the economy following a noisy jobs report. Kelsey Berro of JPMorgan Asset Management writing, for the Fed, a July hike is probably off the table, but more data will be needed to persuade the hawks. Kelsey joins us now for more. Kelsey, good morning. Good to see you.
Good morning.
Is the labour market just okay?
I think that's a fair assessment. So essentially, the payrolls report, I don't want to put too much weight on it as it relates to the path for the Fed this year. I think that the jobs report had implications for the probability of July. But if you look at the market pricing for the end of the year, it hasn't really changed. The market is still pricing a rate hike. And the reason is because I think a lot of the decision around hike or hold is ultimately going to come down to the inflation data rather than the labor market data. Now, our view is that you will be able to see enough sequential improvement in inflation to keep the Fed on hold. But again, it's kind of like a jump ball right now, as you described. There's people on one side that are expecting hikes by the end of the year, and then people on the other side that are still expecting cuts. And when I think about it, this may really be what Chair Warsh was looking for all along, which is have a view on the data and let that data inform where the Fed should be.
I hear from you base case hold for this year. Is that fair?
Yep.
How does that inform your approach to fixed income this morning?
So, when I look at this market, I see a market where all-in yields are attractive. We're continuing to see a lot of flows into fixed income. And this is a market where you want to have carry in your portfolio, and that is going to benefit you. So we talk a lot in fixed income about fixed income protecting you in terms of a recession, in terms of the downside risk. We're not really thinking about that environment right now. What we're thinking about is an environment where yields are range bound, and what you're collecting is actually the carry, and that carry can actually be very powerful. And what we want to continue to underwrite as we go through the year is the credit side of the story. So do the credit fundamentals continue to suggest that we can be comfortable investing in investment grade and in high yield? And so far, the fundamentals have really been quite strong, even with concerns about increase in issuance. When I look at the range for the IG spread for the index, it's been in a 5 basis point range for nearly 60 days. So despite the fact that we are having record issuance, and that issuance is coming from a new sector of the market, particularly AI and the data build out, things are being well absorbed.
On that point, so with all that IG issuance, especially from the hyperscalers and at the long end as well, is that going to crowd out the long end? And does that basically keep 10-year government and the long end of treasuries just under a little bit more pressure than they would have done?
That's an interesting point. And I would say in terms of things that can keep some upward pressure on long end of the U.S. yields, it's not just the credit supply in the U.S., but it's actually Japan this morning reaching new record highs in terms of yields there. But I would say what we're seeing is the price discovery is a little bit more tricky on the long end of the curve, particularly for hyperscalers. And if there was an area where I think that there is still kind of room to fully understand where pricing should be, it would be where should those 10s, 30s credit curves spreads really be for some of the hyperscaler names. But when I think about it more broadly, what we're seeing is that these names are generally being well absorbed into the market. And, when we look at the fundamentals, demand for compute is expected to exceed supply for at least the next 2 years. So there's a very long runway for them.
Let's go back to the Fed and data dependency for a moment. So if we're moving away from a world of forward guidance, what does that mean for volatility around around economic releases, around the FOMC dates, and just the impact that can have both on different parts of fixed income, whether it's government or credit?
So I think volatility may be higher, but I don't want to put too much emphasis on that, because I actually think we've been moving away from forward guidance for quite some time now. So this is really more an evolution than a revolution. And we've been kind of peeling back the layers of that onion as the Fed has gotten further away from the zero lower bound. And so essentially we were already operating in a generally data dependent framework, one where the Fed couldn't give a lot of guidance because we're around neutral, and the next move from here is a little bit more uncertain. And so, is the data important? Absolutely. I think about CPI coming up July 14th. That's going to be really important for the market. But this is the way that the Fed has been trending in terms of their, strategic goals for a while. And interestingly, it's not just the Fed. We're actually starting to see other central banks kind of all have very similar messages. So last week in Sintra, I thought it was interesting the phrase that Lagarde used, which is we're moving from forward guidance to framework guidance, which I thought was kind of clever. I think the challenge is, particularly for Chair Warsh, is we don't really know what that framework is yet.
I think the ECB is looking increasingly confused after making what looks like a policy error in the last month, aren't they?
Yeah, the data is looking softer there. We're already starting to see some downside surprises to inflation, both in Europe, also in emerging markets. And that's why we do see value across a number of the different government bond markets, is because some of these central banks have hiked rates, or they've talked very hawkishly, even as we've really taken some of the inflation pressure off because of lower oil. The central banks are still staying fairly conservative. The markets are keeping some of that term premium in. But ultimately, we may not need to deliver all those rate hikes that are priced. So whether it be the ECB or some of the emerging markets that we follow, like Mexico or India, you know, there's some value in those curves that we're looking at right now.
Kelsey, good to see you. As always, Kelsey Barro of JPMorgan. Special thanks to Alex Altmann, who was up all last night looking at the score and trying to get some sleep at the same time. Alex Altmann of Barclays. Alex, thank you, buddy. Coming up next, we'll catch up with Mike Wilson of Morgan Stanley, Henrietta Treyz of Veda Partners, Noah Weisberger of BCA Research, Neil Dutta of Renmac. The second hour of Bloomberg Surveillance is just around the corner.
We've had a very resilient economy.
We're sitting in a labor market that's largely in balance.
It's not that wages aren't robust. They're just not robust enough.
A hike is not out of the table. Our call is for the Fed to keep policy on hold for the remainder of the year.
It's wiser for the Fed to wait.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Equity futures adding some weight to the rally on the S&P 500, up by 0.5, adding to a weekly gain, the biggest weekly gain on the S&P 500 going back about a month. On the Nasdaq 100 this morning, tech back front and centre, up by 1.15% on the Nasdaq 100 this morning. The Russell slightly underperforming, up by 0.1% so far on Monday. Into the bond market we go. 2s, 10s and 30s. Crude is lower. Jobs data softer than expected, unlocking this move at the front end of the yield curve. Yields down on Thursday into the long weekend, down again this morning. We're down 3 basis points at 4.11%. 10s, sub 450, down by 2 basis points at 446. Going into this week ahead, it's packed with data. Later on this morning, we get a PMI at 9:45 Eastern Time and ISM around 10 a.m. Through the week, the focus shifts to South Korea of all places, but that's the market we're in right now. Quarterly earnings from Samsung tomorrow. Look out for that on Friday. A listing from SK Hynix looking to raise $28 billion. One of the biggest equity capital raises we have ever seen, coming from a name that was hardly talked about a few years ago. That's the week ahead for you. This is the next hour or so. Coming up, we'll catch up with Mike Wilson of Morgan Stanley, expecting the market to continue broadening in the second half. We'll catch up with Noah Weisberger of BCA Research, raising his year-end price target on the S&P to 8,100. And Neil Dutta of Renmac, breaking down what he calls an uneven economy following what he calls a disappointing jobs report. We begin this hour with stocks adding to gains to kick off the first full week of the first quarter, the third quarter. Mike Wilson of Morgan Stanley writing, falling energy prices, peaking tariff inflation and contained services keep the Fed on hold rather than hiking this year. Lower real rates should support equities and further fuel the broadening trade. I'm pleased to say that Mike joins us around the table for the next hour. He joins us for more. Mike, good morning. Good to see you.
Good morning.
Let's just start with the stability we're seeing in the rates market and how important that is to set the stage for what you're anticipating in the next few months.
Yeah, I mean, I think you were saying it earlier. I was listening to the show. I mean, there's somebody expecting a hike, there's someone expecting a cut, and we're on hold. And this is, I think, what we got to get used to is that with the new chair probably not giving as much guidance, he's going to allow the market to kind of figure it out on its own and have these different views. We're in that adjustment period now. And I think that's one of the reasons why the market's been a little choppy or even correcting in the last month or so, is we're getting used to this new regime, which is going to be higher volatility and potentially the bond market. But over time, I think what's going to end up happening is the market's going to settle down. It's actually more estimates, a wider dispersion of estimates, actually leads to lower volatility in the pricing over time. But we're in that adjustment period. So we think rates are lower ultimately, particularly at the back end. And oh, by the way, we've talked about this on the show many times. New Treasury Secretary, new Fed chair, this kind of new Fed Treasury accord to really anchor the back end. That's what they're focused on. You got to get the back end down, or at least anchored, because you have so much debt that you have to basically finance.
Do you think in the meantime we're confusing a reduction in guidance with an increase in hawkishness? Yes. Just in the meantime?
Yeah, I think that's right. And the market's pricing that now. So that's the good news, is that we've already had that adjustment. And that adjustment started 4 months ago, right? This is why precious metals have traded really poorly. The day that Wolfe was announced as a nominee, the gold market peaked. And that was a sign the dollar has been stronger. So once again, the market has really gotten ahead of this.
So rates have reset. We've come down from around 4.2% to 4.1%. There's a belief this morning, at least, we've removed the urgency to hike as soon as July. So we can put that story to bed. Crude's decline, massive reset in crude from triple digits down to the 60s on WTIs. Does that open the door within the equity market? And let's talk about the stock market exclusively. Does that open the door to the broadening trade again?
Yeah, that's our call, basically, is that was happening at the beginning of the year. Then we had Venezuela and then Iran. By the way, the market priced Iran before the invasion even happened, or the attacks happened, because once again, it was pretty well signaled. And so that's when the broadening trade stopped. The broadening trade literally stopped the day that the attacks happened, and we had the big spike in oil, and then the pricing of the Fed to hike rates. Since, I say mid-May, which is when we reiterated the broadening call, we had a different view than most. We thought oil prices would come down. And that has allowed now Fed pricing to sort of stabilize, and that has allowed the broadening trade to reignite.
Small caps have performed nicely, just had a massive quarter, up by more than 20% on the Russell. We've seen the broadening trade speak to the performance we've seen in the equal weight on the S&P 500 as well. Let's talk about the Mag 7, which increasingly was called the Lag 7. You've got a note out this morning talking about maybe the money going back into the hyperscalers. Just walk us through how you're thinking about what's happened in tech and that divergence between the big spending companies and the beneficiaries of all that spending, and the divergence that's what really widened in the last few months.
Yeah, I mean, there's a symbiotic relationship between the spenders and the beneficiaries, and typically they trade sort of in lockstep. And a couple things we've been writing about for the last several months. Number one, CapEx to sales, that particular factor has been straight up since the Big Beautiful Bill was passed, right? That basically the government's incenting businesses to spend money today rather than later. And so that CapEx to sales factor has been driving a lot of stocks higher. That looks like it's peaking now. And by the way, the hyperscaler stocks started to trade poorly about a month and a half ago and into this idea. But that's not sustainable. You can't have the spender stocks trading poorly and the beneficiary stocks continuing to go straight up. And now what we saw last week, Meta announced that perhaps they're going to sell some excess capacity, maybe turn into a provider of capacity. That is just a reason for these things to take a break. Also, peak rate of change on revision breadth, right? The memory stocks, the revisions have been spectacular, but they can only go so high. So all of that's kind of happening at the same time. And I expect the hyperscalers now to stabilize. That's what's going on in the last couple of weeks. And the semiconductor stocks are going to correct. That's a good development. That doesn't mean the CapEx cycle is over, but that ebbing and flowing between the two is a natural kind of governing factor, because you can't have this divergence continue. It's unstable.
Your words, take a break. That's interesting. Some people have called it a narrative shift for the overall trade, and maybe a shift in spending too. Why is it one and not the other?
Well, we don't know for sure, but we've had 3 of these already, John. So since ChatGPT was announced in November of 22, we've had 3 of these sort of mini cycles within the broader structural CapEx cycle, which is that the market starts to question, the return on capital isn't good enough to support this kind of CapEx. What happens then? The stocks trade poorly, and then the CEOs of those companies come out and say, well, maybe we won't spend as aggressively, and then it ebbs the other way. And so that's the story. That's the dance back and forth. Now, there is going to be a period, there is going to be a time, we don't know when it's going to happen yet, where the CapEx cycle will exhaust itself. And we will have, we've talked about this, that there is going to be malinvestment here. We don't think that spending cycle is over, because they just started raising the capital in the credit market. So they're going to spend the capital, okay? But we can have these mini cycles in the structural bull market of CapEx.
I think, as you know, though, forget the spending that's not yet happened. It's the intentions that matter, and a deceleration in CapEx intentions from here. How do you think this market's going to internalize the prospect of that in the coming months?
Well, it's doing it right now. So we talk about it as a peak rate of change, or trough rate of change, second derivative growth, and that's exactly what's going on. There's 2 things we're focused on. Earnings revision breadth for the semiconductor stocks themselves are like 75%. That's about as high as it goes, and we've documented that. So that's going to roll over. That doesn't mean it goes negative, but the deceleration on that can cause those stocks to correct. And then, of course, the hyperscalers will benefit if the market perceives these companies as being somewhat CapEx disciplined, that they're not going to do willy-nilly spending in a way where free cash flow goes to 0 or negative. And by the way, free cash flow expectations for some of those companies are going towards 0. That's why they've underperformed. So it's this dance, like I said, back and forth. And now, in the last week and a half, some of the hyperscaler stocks have started to trade better. That's a good sign that we're going to have this little correction. This could last, 4, 6, 8 weeks, something like that. And then we'll probably have the next upcycle for the semi.
These newer names that were in bear markets. I'm talking about Meta and Microsoft. Meta had a better week last week. Chips, you keep using this word correct. When I hear that, I'm just thinking, what do you mean by that? How much is the downside? How big is the downside for some of these chip names?
Well, these are high beta stocks. I mean, they can correct 30, 40% in a bull market. No, by the way, just look at the 200-day moving average. That's probably a really good gauge. These stocks are so extended relative to those moving averages. That's how you got to think about it. Those moving averages exist for a reason, right? they always return to the moving averages. Does it happen in a violent way, or does it happen kind of gradually over time? We'll have to wait and see. But yeah, 30% correction in these stocks is, I mean, well within possibility. In fact, some of them already have corrected 30%.
You can have a 30% correction in chips. Just bear with me here. And you can still see the index move up and to the right on the S&P 500, even with the massive weighting they have.
But we didn't say
S&P.
that.
That's what I'm asking.
No, but I mean, that's part of our call, too, is that we think this rotation is happening in a down tape.
Okay.
Unlike the correction we saw in the precious metal stocks in January, because they're such a small part of the index. Energy stocks had a big correction after having a great run in January and February. Now the market traded off a little bit because of the war itself. But so I agree with what you're saying, or your premise or your question, which is, since these stocks are such a big part of the index, it's going to be really hard for the index to make any upward progress until this rotation has sort of happened.
This is a summer story for you?
Oh yeah. I mean, we're not bearish on the year end. We're still 8,000 plus for year end, and we've had that call for quite a while based on the earnings story. So that earnings story is very much intact. In fact, the fact that we're rotating now to some of these other areas almost confirms the thesis we've had all year, which is this is not just a tech story. That's a great story, but the broadening story is the story that I think people have really underestimated. The rolling recession from a year ago, this operating leverage story, which I think is still very underappreciated.
Do you think the banks can start working now too?
Well, they have been. I mean, the money center banks and the capital markets banks related have been
Your
phenomenal.
stock, absolutely. Goldman stocks, fantastic. I'm talking about the others.
The regionals. And so they've started to perform, and that's been an area we've been highlighting. Now, the yield curve's flattening still, or is having trouble kind of re-steepening. So I think that group could pause a bit. We took that off of our list of favorites for the broadening trade this week. But ultimately, between now and year end, we do think the banks are going to do quite well, because this is the strategy of the Treasury and the Fed, is they want more lending going through the traditional lending sector. So while the yield curve is flattening, loan growth is accelerating, and that's feeding this whole broadening out story of the economy, right? This is a strategy of the administration. They want a privately driven, organic economic expansion, and that's what we're getting. Notwithstanding that maybe the labor market isn't as robust as some people were hoping, but that's also then feeding the earnings story, right? Because you're seeing revenue growth without a crazy need to hire a bunch of people, and that's the operating leverage story 101.
We'll talk about that cost discipline through the hour. Mike Wilson of Morgan Stanley is going to be sticking with us. Equity futures near session highs up by about 0.4% this morning on the S&P. With an update on stories worldwide, with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. A cargo vessel in the Red Sea reported that it came under attack from armed assailants southwest of Yemen. The AP reporting a skiff approached the bulk carrier and opened fire Sunday. The ship returned fire, and according to the British military, no one was hurt. SK Hynix gearing up for what could be the biggest ever first-time share sale by a foreign company. The South Korean memory giant expected to list on the Nasdaq this Friday, raising about $28 billion. Hynix's core valuation is likely to depend on memory demand, AI spending, and Korean macro conditions. In sports, Brazil is headed home from the World Cup in their earliest exit since 1990. Norwegian superstar Erling Haaland scored both his team's goals to send them to the quarterfinals for the first time in Norway's history. They'll be facing England, who defeated Mexico on home turf, overcoming a red card to win with 2 goals from Jude Bellingham and another strike from Harry Kane. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, a push for NATO spending.
We're very disappointed with NATO because NATO has done absolutely nothing.
They don't want to help us defend the strait, and they're the ones that need it.
I'm very disappointed in NATO. We pay trillions of dollars for NATO, and they weren't there for us.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Returning from the long weekend with stocks positive here, up by 0.4% on the S&P. On the Nasdaq 100, up by 1 full percentage point. Bit of underperformance on the Russell. We had some outperformance more recently, up by not even 0.1% this morning. That's the equity market picture. Turn to the bond market board. Some data later. We get a PMI at 9:45 Eastern. ISM services 15 minutes after that, so look out for that in a few hours' time. On a 2-year this morning, ahead of that, we're down about 3 basis points. The 2-year, 4.1%. Unlocking this move in crude. WTI and Brent down again, declining declining by, let's call it 0.1%. Brent crude at 72, WTI around 68. What a reset we've seen in the energy market. And the surveillance this morning, let's talk about policy and the week ahead. A push for NATO spending.
We're very disappointed with NATO because NATO has done absolutely nothing.
We don't need them, but they should have been there.
They don't want to help us defend the strait, and they're the ones that need it.
We'll come to their rescue, but they will never come to ours.
I'm very disappointed in NATO. We pay trillions of dollars for NATO, and they weren't there for us.
So here's the latest this morning. President Donald Trump heading to the NATO summit tomorrow. The president preparing for a busy schedule in Ankara while renewing calls for allies to increase defence spending. With the latest, Tyler Kendall is in Washington. Hey, Tyler.
Hey, John. Well, as President Trump renews his threats against the NATO alliance, we had the NATO Secretary General Mark Rutte here in Washington just the other week in a bid to smooth ties ahead of the summit. He pointed to what has been an increase in defense spending among European countries, as our analysts at Bloomberg Economics find that the top 5 European economies are on track to spend about 2.5% of GDP on military spending this year. For context, that's up about 0.5 percentage point from when President Trump took office, though not all countries are on track to meet that 5% total goal that the White House is hoping these allies will hit by 2035. The U.S. ambassador to NATO, Matthew Whitaker, just last week touched on this point, previewing the trip to reporters last week in Turkey. And he seemed to say that the U.S. feels that the countries that spend more should get more benefits from the U.S., though he declined to say what that would actually entail. We do know that the U.S. right now is planning to withdraw nearly 5,000 troops from European countries and says that it will slash the assets that it would be willing to deploy in a time of crisis. John, we'll have to see what ultimately comes from this summit. We are expecting perhaps some defense deals to materialize, as well as the German chancellor will reportedly pitch the U.S. on a joint weapons production agreement that could see investment in U.S. defense companies.
Tyler, do you want a quick word on the diplomatic spat with the Belgians as well? Thank goodness this is not taking place in Brussels and it's taking place over in Turkey over the next few days. What's the reaction in Washington been to that?
Well, I think as U.S. soccer fans, the reaction has, of course, been in favor of that red card being reversed, though it is certainly raising some questions from a journalistic perspective, as well as from some lawmakers here on the ground about the president's very close ties with the FIFA president. Now, we should say, John, this isn't the first time that we've seen such a reversal take place. You'll recall at the beginning of the tournament, we saw that potential suspension of Ronaldo reversed during one of those qualifier games. And ultimately, the U.S. player will still face at least some sort of repercussion for this. I believe he'll be on probation for 1 year, though he is still allowed to be on probation. Of course, we should remember that President Trump was awarded the FIFA World Cup Peace Prize earlier this year.
Got no idea what that Peace Prize even means. Tyler, thank you. Tyler Kendall down in Washington, D.C. Most read stories on the Bloomberg terminal this morning. In at number 7, Mike Wilson, Morgan Stanley, looking for rotation from chips to hyperscalers. So there you go, Mike. Elsewhere on the list, it's not number 1, tech, NVIDIA, EasyJet. Number 1 is FIFA, allowing Balogun to play after Trump called and he sparked uproar with the Belgians. That tells you where the head of the market is at this morning, going into the week ahead. Henrietta Treyz of Veda Partners looking forward to the NATO summit, saying it's a prime opportunity to direct attention away from the war and the energy fertilizer price spike it has created. So investors should be prepared for a flurry of announcements. Henrietta joins us now for more. Henrietta, welcome. What kind of announcements are you looking for?
Well, as you mentioned with Tyler, I think the idea of a joint defense effort with Germany is exactly what the doctor ordered. The president is really looking to deflect away from what is happening in the Strait. And there are so many issues, not least of which is the toll that still hasn't been agreed to and which NATO nations have a real problem with. So I expect them to talk about pretty much anything other than that throughout the next 2 days. The other piece would obviously be Russia and Ukraine and a discussion there as the United States Congress provides substantial funding to not just Ukraine in their various appropriations bills, but also to the neighboring regions, Latvia, Lithuania, and the Baltic region as a whole. And as you were mentioning before, trying to ensure that we keep troops in the region as well, in Poland and elsewhere across NATO nations.
Henrietta, the toll, let's talk about it. I get that the Europeans and others aren't happy about it, but right now it feels like that's the price of admission to get energy moving again. Is there anything they can do about it?
Yeah, that's exactly it. The result of this war is that Iran now has control of the strait. You see it with the U-turns of tankers happening throughout the weekend and on a daily basis as people deal with the general uncertainty of where these 80 mines are in the region. So Iran has the ability here and is using different countries as an example of how to set up a toll. Call it a climate assessment, call it an environmental fee, whatever you want to call it. You're normalizing relations with the IRGC. And this is in many of the NATO nations' opinions. I've heard from Canada, for example, directly, and France directly, simply untenable. They don't want to work with a state sponsor of terrorism. And I would also point out that Treasury Secretary Bessent has created waivers for all these sanctions, but those are only going to hold as long as the administration decides that they will. They've already reversed that several times since the start of the war, and they don't have a lot of comfort from banks or insurers or NATO nations about what the policy is going to be in the future. So this is going to take a while to unfurl, probably much longer than the August 20th deadline.
Henrietta, hi, it's Mike Wilson. I had a question with respect to just how the world may get around the strait itself, in the sense that what this war has highlighted is how crazy it is that we have this choke point to begin with. And how fast do you think the world itself will start to migrate towards perhaps drilling for resources elsewhere or building alternative ways to get the oil out of the region through pipelines, et cetera? How fast can that happen? And will this be talked about over the weekend?
Yeah, perfect point, Mike. I mean, the way to think about this is that it was so obvious that going to war with Iran would result in some sort of closure of the strait. No administration has done it before. Very transparent, very understood. This was a potential choke point. We have many of them around the world, whether it's in the Red Sea, the Black Sea, the Southeast Asian areas. There are problems like this all around the world. So you're going to see now a scramble to try to create alternatives to whatever choke point there might be in the entire world. And what I think, for investor purposes, what this means, and particularly for the Federal Reserve Chairman as they consider inflation, is permanently higher insurance risk, permanently higher costs of doing this shipping, higher tanker rates. And those are all things that we're seeing across the board. So whatever level this settles at is almost guaranteed to be higher than it was before the president made the decision on February 28th to start the bombing.
And what about Taiwan? Is that something that people are still talking about in the mainstream? It seems like that's kind of taken a back seat.
Yeah, absolutely. Great point. So Taiwan has taken a back seat publicly, but in D.C., it's still paramount. You have a pretty substantial bipartisan focus group, not a standing committee, but a select committee on China relations that focuses directly on Taiwan. And I would say that as you look at BIS and what they're doing with export control restrictions, they're very focused on Taiwan. Members of Congress are very focused on Taiwan. So it may not be front and center for this administration. And there's a lot of questioning of how the president's allegiances towards Taiwan differ from prior administrations. But I would say Republicans and Democrats are unified in wanting to continue to provide protections to Taiwan, whatever that takes.
Henrietta, always great to catch up with you. Henrietta Treyz there of Veda Partners on the geopolitics ahead of that NATO summit later on this week. This market, Mike, has been conditioned just to ignore all of this. This market burnt by anyone. Of course, anyone who was short the market at the end of March for the next month or so got burnt really hard. Why should it pay any attention to any of this over the next week?
Well, what I would say is that the market tends to get in front of this stuff. So what I'm trying to figure out is what is it digesting in the next 6 months? And this is one of the reasons why I'm not that bullish in the short term. I think we have discounted low oil prices at this point. I mean,
you think it's done? It's in the market?
Yeah. Well, it means oil prices are $70 again. So it's going to be hard to really get oil prices below that level, without, significant new source of oil or maybe demand being destroyed further, which is probably not a good thing for growth. So I think this is another part of the story is that the market got ahead of this in April and May. It said oil prices, the rate of change on oil prices have peaked. Okay, the conflict that continues to go on between Ukraine and Russia. I mean, to me, this is sort of back and forth, and it's uncertain. But the market, just like tariffs a year ago, the rate of change, the worst part of it is now behind, and markets are always forward thinking. So I'm trying to figure out what's going to happen in 6 months, not what's happening next week.
Brent crude this morning, 72. WTI around 68. Coming up next, Noah Weisberger of BCA Research raising his year-end price target for the S&P to 8,100. Plus, Yahira has some morning movers. Memory stocks getting a boost ahead of SK Hynix US listing later on this week. Live from New York City this morning. Good morning to all. You're watching Bloomberg TV. Stocks doing better this morning, up by 0.4 on the S&P 500. On the Nasdaq 100, up by 1.1%. We talked about the outperformance on the Russell. Underperformance this morning, up by 0.14% on the Russell of small caps. Just a little bit higher. Into the bond market we go, 2s, 10s and 30s. I mentioned this a few times. The data later on this morning, 9:45, a US PMI. Services ISM dropping at 10 a.m. Eastern time, so look out for that as well. Going into a week sprinkled with Fed speak. You'll hear from New York Fed President John Williams a little bit later in the week, so look out for that as well. FOMC minutes dropping in a few days' time too. On a 10-year, we're down by 2 basis points, 4.46. Want to finish on crude, talk lots about it. WTI and Brent reset. What a reset we've seen from triple digits down to the low 70s on Brent, wiping out the wartime rally on WTI back to the high 60s, 68.60 this morning, and down about 0.1%. That's across asset price action. Let's get you some single names and morning movers. Yahara has more. Hey, Yahara.
Hi, John. After a rough sell-off, we are seeing the semi and memory names rebounding this morning as optimism builds over 2 key events this week that will test this trade. We get Samsung earnings tomorrow and SK Hynix planning to list on the NASDAQ on Friday. And investors are looking for fresh confirmation that demand remains strong for AI memory chips, especially after that our reporting last week on Meta looking to sell computing power, and that raising fresh questions about the demand picture. Speaking of Meta, we are seeing those shares rising and outperforming the Mag 7, up just under 1.5%. And while there's no specific company news, we did get a fresh call from the man sitting with you there, Mr. Mike Wilson over at Morgan Stanley. He says the next rotation is from the semiconductor names to the hyperscalers, arguing they've already gone through their period of underperformance, and he prefers it as a better way to play the AI trade due to their strong core business. And we end over in London with shares of the UK budget carrier EasyJet. Shares are soaring nearly 10% in the pre-market after it agreed in principle on a $7.3 billion takeover from the U.S. private investment firm Castlelake. But even with this rally, the stock still remains below the offer price, signaling some skepticism by investors around the deal. John?
Yahara, thank you. Thank you very much. EasyJet doing OK. On our radar this morning, President Donald Trump expected to arrive in Turkey Tuesday ahead of a NATO summit following a series of critical remarks about the alliance.
We're very disappointed with NATO because NATO has done absolutely nothing. We'll come to their rescue, but they will never come to ours.
We pay trillions of dollars for NATO, and they weren't there for us.
The US ambassador to NATO sharing, quote, President Trump expects all allies to step up immediately. And elsewhere, South Korea's SK Hynix preparing for an American debut and blockbuster $28 billion US stock listing. The offering would be among the top 3 first-time share sales by a foreign company. Trading expected to begin Friday on the NASDAQ. And finally, said it a few times, the most read story on the Bloomberg this morning, FIFA overturning the suspension of US top scorer Florian Balogun, clearing him to play in tonight's World Cup match against Belgium, following a personal appeal by President Donald Trump. FIFA pulling back the red card in favour of a 1-year probation. And that right there, 3 of the stories on our radar this morning. Let's get back to the equity market. Stocks lifting high with investors eyeing another big week for the AI trade. Noah Weisberger of BCA Research recently raising his year-end price target from 7,700 to 8,100, writing earnings strength remains the core driver of our constructive outlook. The story is no longer confined to a small group of hyperscalers. Noah joins us now for more. Noah, good morning. Good to see you.
Good to see you.
Put some numbers on it. Why the move to 8,100?
I think two things got us there. One was Q1 was better than we had expected, so part of it was a little bit of a mark to market. I mean, I try to stay away from superlatives, but what we learned from Q1 was really just excellent in terms of the demand side for the AI CapEx spend, that there was real demand behind it. And then the second was the economy shifted from a patch of slowing to a patch of what we think of as reacceleration, and some of the risk barometers have eased. So I think that all put us, half and half, I would say. And I would also say we're leaning heavily on earnings and not on more multiple expansion to get us to 8,100.
One risk factor. It's in your note. You say AI-related investment generating excess capacity, and you say at present you see little evidence of that. Are we starting to see some evidence from Meta, from SpaceX, that there is capacity to sell?
Yes, there may be capacity to sell because the prices are so strong, as opposed to demand waning. I think any signs of demand, and this is going to sound like being optimistic, contorting myself to be optimistic, but I don't think that's the case, is that I think what we're facing is almost like a kinked supply curve where demand is being met by higher prices. And so there may be some pullback in demand, but not because demand, underlying like latent demand strength is weakening, but just because it can't be had at that price. So I think as you see token prices get a little bit weaker, I think that's a bit of a pullback, but not because we don't see a longer term demand path, but the equilibrium until we get more capacity to meet that demand, I think is what's going on here.
I'm curious where you raised your numbers because you said you raised your numbers. What sectors surprised you most on the upside, and where do you think that can continue in the second half?
So not surprisingly, it was tech, materials, and industrials. And I think it was the speed at which that CapEx flowed through to the market, and that's where we're leaning on heavily still. I mean, I know June was a pretty big rotation, but that's not where the fundamentals are. We had a really neat piece of analysis that looked at sector returns have been highly correlated to EPS growth expectations for much of the last year, 6 months, 3 months, and in June that really just collapsed. So we think the earnings growth stays where it was. That's where we leaned in a little bit more, and that's what surprised us in Q1.
And where are you on small caps right now?
Uncomfortable. I don't like the beta. I mean, it's a beta trade right now. The reasons the things that we like in the large cap universe would make us not like what's driving small cap. So small cap has weaker earnings growth. They have less strong balance sheets. All the things that we kind of think are nice features, maybe not of some of the hyperscalers, but of the tech sector more broadly, we don't think are there in small caps.
What do you think has been working then?
Risk on. Right, I think, and I say that. Well, let me caveat that a little bit. I think June was a little bit of a rotation and a little bit of a growth relief. Maybe not pure risk on, but a cyclical upgrade, and we saw that in the data. If I didn't know about AI, and I was just looking strictly at my kind of macro numbers, we got a bit of an upside surprise there and a bit of a relief on the oil price. So to see beta and cyclicals move doesn't just have to be the AI trade.
To Noah's point, I mean, the Russell 2000 has outperformed the S&P 600, right, which is a quality index relative. So it's been a bit of a risk on, and there are a lot of these names that get as a big tail that are beneficiaries of that CapEx. I actually think the S&P 6 may start to do better now than the Russell 2.
Another trade of Mike's that we talked about a little bit earlier on this morning, the AI beneficiaries, the spending beneficiaries, the chip stocks that have really benefited from all this spending coming from the hyperscalers and the likes of Meta as well. Mike's thinking about that reversing through the summer. Do you share that too?
So we're broadly in tech. We put on a little bit of risk prior to Q1 in software because we thought multiples were just too soft given what the earnings growth was. But I would lean, we're going to stay diversified in the sector, but if I had to lean, I would lean back into the hyperscalers. I like the notion that they own all the margins, they own the full stack. I think of them as the integrateds of the 70s and 80s maybe, where they don't have to worry exactly where you are in that cycle. And semis have just had a remarkable run. So you don't need to dislike them to want to balance a little bit away.
How do you feel about software specifically? I mean, their business models are being challenged. There's also overcapacity from all the companies that were started during the cloud revolution. Like, where are we in that corrective activity?
So again, prior to Q1, I thought we had overdone it. What we learned in Q1, I thought was on the majority favorable. As we looked at Salesforce, Intuit, Oracle, maybe not because of they're not spending like a software company. They're spending like a hyperscaler. But what we've seen from the company commentary is that they are able to monetize on the revenue side AI with some of their products. And to me, that's a winning formula. Picking the winners harder, the subsector or the industry overall, I favor, right? I mean, I think I like things that are inexpensive with earnings growth that's still maybe not accelerating the way it was. Maybe acceleration is moderating, but we haven't even seen peak earnings yet.
And how are you thinking about the Fed now? I mean, obviously we have a new chair, maybe a little less communication, maybe a little higher bond volatility. How important is it that this transition goes smoothly for your case to play out this year?
I would say hugely important, and I was much more nervous 10 days ago, let's say. I think the way we've thought about this market, the tilting point here ends up being, I'm not worried about valuations on a multiple basis, like, okay, so you're paying a high multiple, open the aperture and look a little further out. But I think when you're paying a high multiple and dividend yields are low, it's duration risk. So there's a lot of duration in the equity market. Small wobbles in the bond market will make you nervous. And I think the worst case scenario would have been if Warsh had even had dovish body language, make people question how rock steady that independence was. And that's bond volatility, that's uncertainty about the reaction function. That would be a toxic stew. I think we got the opposite.
You think that helps?
So I actually think his hawkishness might have been painful on the day or two, and I think long-term as an equity investor, anything that anchors long-term inflation expectations, I think gives you comfort in the long term. Well, June's been about, I think, rebalancing and some tactical issues, but the thing you like least is a yield curve steepening on a dovish Fed in the near term and inflation expectations at the back end. I think that would be toxic.
Things have stabilised. What's your base case now for the Fed for the year ahead? Unchanged, on hold?
I'm going to go unchanged because that's leaves me latitude both sides. If I had to pick, I think we could get a little bit more, I don't know, easing, but hikes coming out. And I think mostly because of the headline inflation risk, I think starts to fade. And I think the Fed and maybe the economics profession more generally have been chastised a bit by the transitory inflation call of 2 years ago.
Right.
But this is with oil. I mean, you said it before. With oil at $65, let's watch what headline does and how that affects Fed futures.
Noah, it's good to see you. Noah Weisberger there of BCA Research. Mike Wilson of Morgan Stanley is going to be sticking with us. Dutta of Renmac is going to drop by in just a moment. He'll have his own thoughts on the outlook for interest rates under Fed Chair Kevin Warsh. Equity futures this morning, stable, positive, up by about 32 on the S&P. We're positive on the S&P 500 by 0.4%. In the bond market this morning, twos yields lower by 3 basis points. Your 2-year around 4.1%. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. NVIDIA's next-generation AI server reportedly facing delays of more than a year. A report finding setbacks in the construction of printed circuit boards for the platform. The report sending shares of several Asian tech stocks lower. NVIDIA has not yet responded to requests for comment. US beef exports to China are picking up as its competitors are running out of quota. Brazil, Argentina and Australia have either run out or are near using up their total allowance to sell to China, as the country puts caps on foreign beef producers to protect local farmers. In sports, Naomi Osaka stunned top-ranked Aryna Sabalenka in straight sets. Meanwhile, American Coco Gauff advances to her first Wimbledon quarterfinals. On the men's side, Novak Djokovic is moving on with his record-breaking 106th Wimbledon win. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in the next hour. Up next on the programme, coming into balance.
You're probably just in a pretty good balance. The economy's in a decent spot. The labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking, and that buys them time.
Neil Dutta of Renmac joins us next, live from New York City. You're watching Bloomberg TV. Looking at the week ahead, some data later this morning. PMIs, ISM later this morning at 10 a.m. Eastern Time. A read on the service sector in America. Look out for that later this morning. Later in the week, FOMC minutes coming up on Wednesday. How much of a family fight was there over that statement? Very short statement. Not much to disagree on, given the length of it. Looking ahead to all of that, plus this, South Korea, just at the epicenter of markets worldwide at the moment. Quarterly earnings from Samsung in focus tomorrow. Then later in the week, a $28 billion capital raise from SK Hynix, an ADR listing here in the United States taking place on Friday. Look out for that. Equity futures into that, positive by 0.4% on the S&P 500, on the Nasdaq up by 1 full percentage point. In the bond market, yields lower by 3 basis points on a 2-year at 4.1%. Under surveillance this morning, coming into balance.
You're probably just in a pretty good balance. The economy's in a decent spot. And the inflationary pressures don't seem to be generated from the labor market. It seems to be generated elsewhere, in which case that should roll off. We expect about 100 basis points coming off core PCE by the end of 2027. The labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking, and that buys them time.
So here's the latest this morning. Wall Street looking for the next gauge for the Federal Reserve. PMI and ISM data due out later this morning ahead of minutes on Wednesday. Bloomberg's Ender Karen joins us now for more. And there is a take at the moment, and good morning to you, buddy, that after the payrolls report of Thursday, we've just removed some of the urgency around the rate hike debate. Is that your take too?
I think that seems to be the vibe around the market, John, no doubt about it. I mean, the jobs numbers did take steam out of that story, softer than the market expected, but no disaster either, remaining above that kind of 50,000 area that some economists say is the break-even pace. So, I've seen economists say it was kind of a Goldilocks or as good a number as the Fed could have hoped for. We probably won't get too much new information on the Fed debate in terms of the data this week, John. As you mentioned there, we've got the ISM services numbers coming up, expected to be a touch of softening there on the back of high inventories and weaker order books, bringing down overall orders. Regional surveys have already pointed to that. And then we get some trade data tomorrow expected to show weaker exports, strong imports because of the AI capital boom. But as you say, the bigger focus on the Fed story, I think, is going to be the Fed minutes on Wednesday.
Looking forward to it. A few days away. And good to catch up with you, sir. Thank you, buddy. And Karen there, down in Washington, D.C. Here's a take from Neil Dutta of Renmark, writing, June's employment report is a reminder that the economy remains uneven, inflation remains too high, and so the threat of hikes is not receding. Neil joins us now for more. Neil, good morning.
Good morning, John.
It's good to see you in person, buddy. I'm not going to bury the lead. You are not impressed with Kevin Walsh, Fed chair. Why?
Well, I mean, I think he's kind of blurring the lines between the Fed having a reaction function and forward guidance. Getting rid of forward guidance is fine. No one needs to be spoon-fed every single meeting in advance. That's not what this is about. But just to say, kind of swear on the monetary policy Bible stack and say, I believe in price stability. I mean, that's fine. But the question is how you actually achieve that. And and in my opinion, he hasn't really done much to tell us how that will be achieved. So it's really about how they respond to data and how that kind of drives their decision-making process. And we don't really know much about that, which, if the market has one view of it, and the Fed obviously has the whip hand, they know more about their own reaction function than the market. It could mean that the closer you get to these meetings, we won't know their reaction function until it's revealed, in which case it creates some volatility in the financial markets. I think it's fine so long as things are stable, as guests have been saying, but that may not always be the case. So he's going to have to tell us eventually, and I would say sooner rather than later.
In the meantime, is the ambiguity strategic? Do you think it is beneficial?
I think for him it is, right? I mean, in the sense that I think by failing to, he's been very vocal about not wanting to submit dots, give a forecast, anything like that. But I think because the Hawks really are ascendant on the committee, the last jobs number didn't matter one way or the other. It's really about the inflation data. That's going to break the tie, so to speak. But by not submitting a dot, he absolves himself of having to take responsibility for the Hawks on the committee, and so it's kind of interesting. I mean, it's, you do see some guidance from people like President Trump, NEC Director Hassett talking about, well, in his heart of hearts, he's actually dovish, but he has these sort of people he has to deal with. And so, I think it kind of, it absolves him from having to kind of take responsibility if he's able to say, look, I didn't submit something.
At the end of the day, though, don't we need higher inflation to grow out of the debt problem? And so he's talking about rewriting the data sets that they're going to use to sort of justify maybe inflation is really only 2.5, but reality is every American knows it's much higher than that. We've been going through this song and dance for 10 years. So what's that framework look like? And what is the real target inflation rate, you think, to actually grow out of the debt problem?
I don't know, Mike. We'll have a task force for that. To borrow from our chairman. No, I don't. Look, I don't think you can inflate your way out of this. You have to grow your way out of it. I remember back after the financial crisis, people were making the same argument. We had to, and what ended up happening? We essentially grew our way out of it, right? We had sort of stable growth, stable inflation, and over time, things kind of evened out in the bond market. So, yeah, I don't think he's leaning into the inflation piece of it to the extent he's been leaning into anything in terms of dealing with it. It's the productivity boom, the AI sort of golden age thesis. That's been the linchpin for Walsh, I think.
Right, so not letting it, don't kill the boom, as President Trump likes to say. And so having this obscurity around what I'm actually looking at gives him the freedom to maybe not be so reactive to the data sets.
Well, sure, but at the same time, by not laying out a strategy, that's the only thing that people are. The vacuum is ultimately going to be filled by something, and so then you in an odd way, by trying to get people off the data, you actually push them towards the data because they don't actually know what strategy you have.
What do you think he is in his heart of hearts?
I think he's. I've thought he's hawkish, and I think it's almost like a revealed preference. By not saying anything, you allow the Hawks on the committee to become ascendant, and so
and that's what he wants. It's by design.
And you wouldn't have done that if you didn't, at some level, kind of agree with them. The idea that you can the sort of productivity golden age. If you were thinking about that honestly, the fact that inflation is above target, to pull a Greenspan would basically mean to allow productivity to remain whatever it is, to bring inflation down to target. So you wouldn't be advocating for cuts, which is what he's doing. But generally speaking, I think if you didn't lay out a strategy, you allowed the hawks to fill the void, you wouldn't have done that had you not believed or kind of agreed with them at some level, right?
Base case for you. We've got Bank of America on the one side looking for 3 hikes. Citi on the other looking for something closer to 2 cuts this year. That's how wide things are right now on Wall Street. That's quite a spread. Where do you fall?
Well, I think if there was going to be a Fed that was dysfunctional enough to deliver a one and done, it would be this one under Kevin Warsh. So that's sort of, I mean, to me, it's sort of, why wouldn't you think the Hawks kind of come back for more? And from his seat, I actually think it makes sense because you can show that you gave a hike, you stood up to the president, you're establishing yourself, your credibility with the market, and now we kind of can get past this and say, look, we got the hike. I mean, almost like the ECB. You kind of take some of the tail out of the inflation risk, and you maintain your optionality. So there's a way for them to perhaps go once without having the market price in a lot more.
And what about balance sheet? Because that's been the real sort of angle on Warsh, is he's a balance sheet hawk, and maybe he's less hawkish on rates, which is, who knows. But do you think it requires market volatility to get them to increase the RMP, for example, or to start doing more liquidity injections?
So I think that this is one of these things where people say things to get the job, to create distinctions between themselves and the people that were there before. And the balance sheet is a good example of that. It's kind of like, hitting Yellen over the head with how she's dealing with bill management and then coming in and then doing literally the same thing. All of these things are going to be met by committee. I think that's something that people say to rationalize it, right? Like, oh, he's not really hawkish. He's just hawkish on the balance sheet so he can be dovish on rates. Like, it doesn't work that way because the balance sheet's not really a tool of monetary policy. The only tool is rates. So I don't think it's, to me, it's not a big factor.
Being hawkish on rates, though, we had this conversation earlier in the hour. Has it allowed the longer end of the yield curve to stabilise? And is that something that both the Treasury and this Fed would look at and say, that's beneficial? That's the kind of approach we need right now.
Yeah, I mean, that the first meeting was the most hawkish meeting that you've had in the press conference era. And we had like a 13, 15 basis point rise in 2-year yields. So, talking helped take some of the risk out of the back end. Yes, I would agree with that.
Do you think he fooled the president?
Do you think he fooled the president in the interview process?
What do you mean?
Oh, fooled him. Yeah, I think if there's a risk, it's that the president was duped. Yeah.
How's that going to play out if he was duped?
I mean, I think there seems to be I don't know. I mean, your colleague Joe Weisenthal said, I think, maybe Warsh hikes and Trump is oddly chill about it. And I don't know. It sounds like he's giving him a lot of grace at the moment.
Depends how close we are to the midterms if that happens, right?
That's why I say get it out of the way sooner.
Yeah. Neil, it's good to see you. Thank you, buddy. Neil Dutta of Renmax. Special thanks to Mike Wilson of Morgan Stanley. Mike, thank you, buddy. Appreciate it. Thank you. Equity futures this morning positive by 0.4% on the S&P 500. We talked about that reset at the front end of the yield curve. Yields down on Thursday off the back of a softer than expected jobs report. Down again this morning with crude stabilising once again. We're down by 3 basis points on twos to about 4.1%. Up next on the programme, we'll catch up with Greg Boutle of BNP Paribas, Tom O'Malley of Barclays, Veronica Clark of Citi Research. Citi still looking for cuts this year. We'll also speak to Earl Davis of BMO. The third hour of Bloomberg Surveillance is just around the corner.
The market has definitely run out of patience.
There's going to be greater scrutiny.
In the near term, the demand is still there. You're seeing adoption rates increase.
The micro is the macro. AI in the markets, it is the dominant feature.
This is kind of where the rubber hits the road.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. 90 minutes away from the cash open. The opening bout just around the corner, with equity futures and your scores shaping up as follows. Positive by 0.4% on the S&P, on the Nasdaq up by 1.1%. The Russell of small caps just about unchanged this morning. Into the bond market, two-year yields reset to 4.1% from 4.20. Yields declining on Thursday following a softer than expected jobs report. Down again this morning by another 3 basis points to 4.1%. Heading into a lot of data a little bit later. Looking ahead to an PMI at 9:45 Eastern Time. ISM services at 10 a.m. Fed minutes later in the week on Wednesday. And I keep going back to this, the focus on South Korea through the week. Earnings from Samsung, quarterly numbers dropping tomorrow. Look out for that. Look out for this. SK Hynix tapping the US equity market for $28 billion with the biggest, one of the biggest equity capital raises we've ever seen for a first-time issuer from a foreign company. Coming up this hour, Sarah Hunt of Alpine Saxon Woods with stocks back near record highs. We'll catch up with Tom O'Malley of Barclays on how memory bottlenecks are reshaping the AI race, and Veronica Clark of Citi on why they still believe this Fed will be cutting rates not once but twice later this year. We begin this hour with stocks gaining as traders pile back into the tech trade. Sarah Hunt of Alpine Saxon Woods writing, we have recently been de-risking our technology exposure, as well as looking for opportunities with strong momentum and valuations that seem more in line with what can be seen as opposed to merely defined ahead. Sarah joins us now for more. Sarah, good morning. Good to see you.
Good morning.
You're going to be with us through the next hour, so we've got time to breathe some life into the way you're thinking about this market. De-risking equities on the tech side. Where and why?
So the de-risking is really, it's interesting because you've had a couple of guests this morning talk about it. It's a little bit more about a rotation, right? So de-risking, funnily enough, means you could go back to some of the quote-unquote lag 7, and you could take some of the memory and maybe some of the semiconductor exposure off the table, just because you've had such a huge run. I mean, it almost seems, everyone's been looking at that and going, when does it end? When does it end? When does it end? I don't know if what Meta started last week is when it ends. I don't know if it ends as much as it changes a little bit, and all of a sudden the frenzy for it becomes a little less. But you can see where there are places where there's been a walking away from it because they were spending.
That's what I wanted from you, the catalyst. What's the catalyst besides up and to the right and vertical really aggressively? Was it Meta? Is it something else?
So I think it's a combination of catalysts. I think Meta is definitely part of it, but then there's questions about whether or not are they doing this because the prices are so good it seems that they should do this, or is it this kind of compute or that kind of compute? But I think if you just look at the trajectory of spend and the massive change that we saw for 2026, are you going to see the same thing in 2027? I mean, it's always been a chasing of, is it time to step away from this? Are we over-earning in some of these places? Is the pricing too high? And I just think that on the margin, you get a few things like that. You get people talking about how many tokens you can use, how much spend you can use. Is that spend worthwhile? So all of those things together, sort of, the AI narrative shifts a lot, and it just is shifting, I think, back again to some of the folks that are in the catbird seat as opposed to the builders.
And Mike Wilson of Morgan Stanley with us in the last hour. It's his trade as well this morning, leaning away from the chip players, leaning into the hyperscalers. He called it potentially a trade for the summer. Do you call it anything more than that?
Again, I think that this narrative goes back and forth so much, it's hard to put anything in a permanent box as opposed to the shifting sentiment. And also from a valuation standpoint, I can look at some of those valuations and feel a little bit better about them than I can on some of the other directions. It's going to be very important what happens this week on the earnings front. I think that the combination of SK Hynix coming to the U.S. and Samsung, all those things are going to matter. And if there's any major change in any of that, I think that it's going to be magnified because of the other things that we're just talking about.
What does it tell you about this moment that we're allowing two South Korean names to set the tone for trading in America this week? What does that tell you about where we are?
I just think it speaks to how international some of that technology trade is. I mean, these are big memory players, right? This is a big deal in what's going on.
They're huge companies.
They're huge companies, but they're also, this is the current bottleneck. So it's not just that they are, it's an international trade. It's an international trade with a lot of places where all of a sudden it's capacitors that are a bottleneck. Here's the bottleneck. So right now you're talking to two of the players and you want to see what they have to say about what's going on there.
That listing taking place later this week. Those are numbers from Samsung dropping tomorrow. Greg Boutle of BNP Paribas with this to say, the epicenter of the recent de-risking has been the Mag 7. This presents an opportunity to carefully add risk. Greg joins us now for more. Greg, I've heard this from Mike Wilson of Morgan Stanley. I just heard it from Sarah. Are you saying the same thing to lean into the hyperscalers here, Greg? Some of the Mag 7 names that have really lagged this market.
Yeah, it certainly feels like it. We think we're moving from an environment that's been dominated by the flows to one that's going to be dominated by earnings. So we turned a little bit more cautious on the market and some of the tech names just over a month or so ago ahead of the SpaceX IPO, where we thought there was a lot of supply, a lot of flow coming to the market. We think we've worked our way through a lot of that, and it sets us up quite well for the upcoming earnings season.
Greg, it's funny you say we've worked our way through a lot of that before we've even got all the rest. We've got the listing from SK Hynix later this week. We've got IPOs still on the horizon. I don't know if we're done with the equity capital raises from some of the big companies, the likes of which we've seen from Alphabet, say. Why do you think the market has fully absorbed that story?
Oh, no, I think that's a very good point, John. And we have to differentiate between the secular story. In the secular story, we're getting to a late stage in the cycle where there is more supply coming to the market. And I'm just talking more tactically. Over the last month, there's been a lot of supply. There's some more supply that comes this week, which, as you said, kind of culminates with Friday and this raise from SK Hynix. But then we look forward over the next 6 weeks or so, and then that environment and that narrative changes just tactically for a little bit.
So what do you think about the overall bigger picture? If we zoom out a little bit and stop talking about some of the places where there's been bottlenecks and just look at what the changing landscape underneath and the usage and everything else, who are you seeing as the best beneficiaries besides the hyperscalers? But going forward into the next 6 months, do you see something changing there in terms of who the beneficiary of this trade is?
Yeah, I think we're going to continue to see these mini cycles of rotation, and the hyperscalers is where we're focused in the short term, because we've seen that rotation, that kind of elastic band between some of these semi names has become very stretched relative to where the hyperscalers are. So that's where I think the next trade is. But we're going to continue to see these kind of mini pockets of rotation where there's a secular bull trend within larger tech, but we have these kind of mini rotations and the leadership jumps from one to the other. Mag 7 is, we think, the next one up for the coming weeks.
And then what happens to the next iteration of where this is supposed to be very helpful? So if I think about the hyperscalers next right now, when I think about some of the discussions about how much token usage people can do and this and that, where do we see a pocket of efficiency coming, or do we see a place where we want to be looking for those efficiencies to start to feel about a broader spread out of how AI is supposed to be helpful?
Yeah, I think these are kind of existential questions in terms of where does the cycle go, how do things evolve in terms of token usage, the AI narrative, and a bigger picture. I don't think we have the answers to those questions. So that's why I think we need to look at earnings season as the upcoming catalyst, focus on that, see where we find ourselves in 6 weeks, and pivot. I think if the market's taught us anything this year, it's that you can't pay at just one big secular trend when you have a series of mini cycles. What worked in January certainly didn't work in March, and what worked in March really didn't work in April, and we think the narrative is evolving for the coming 6 weeks.
So, Greg, the surprise coming into this year was just that overwhelming positive earnings shock that really took many a strategist on Wall Street by surprise. Now you've had a reset. The bar has reset higher following that positive shock. How high is the bar into this earnings season, Greg?
I think it's really high, John, and that's where the risks just incrementally through the cycle do become larger, because at the moment the bar is very high, but the narrative has been that corporates have managed to meet and beat a high bar. We've had this kind of beat and raise environment. At some point in the cycle, that does become more challenging, and I think as the cycle matures, and we do think we're in a late cycle environment, you do start to get fatter tails and larger pockets of risk. I think whilst the earnings growth is strong double digits, corporates beat and raise, the market continues to move higher, but any misses we think could be punished badly. So we still think we're in an environment of dispersion. Those who beat can do well, those who miss can do badly.
Greg, where are the pockets of the equity market right now into earnings season that you are more comfortable with?
It would be the Mag 7 would be, I think, the obvious place to be, just looking at the price action. We think they've suffered disproportionately when you look at just the index weighting. If people were trying to raise money for both the issuance this week and the supply that we've seen for the last month, that's the obvious place to raise it from. So I think within tech, Mag 7 is the obvious place to go. I think some of the banks potentially look interesting as well. There's obviously been a lot of talk about what's going on in terms of inflation, in terms of rates. I think the balance sheet is something the Fed will look at, and that potentially raises the idea of banks maybe being an interesting hiding point if you want to play broadening out away from tech.
Greg, thank you. Appreciate it. Greg Boutle there of BNP Paribas on the financials into next week. Next Tuesday, unusual one. We'll get numbers from Goldman, JPMorgan, Bank of America and Citi all reporting on the same morning. Sarah, your thoughts on the financials What kind of opening is there now for this trade?
Well, I think that just adding the IPO movement that we've seen in the last month or so and what we think is coming has to be helpful to an area where that's been off the table in terms of earnings for some time. And I think that, there's been a lot of rotation, which is generally good for banks. I think that it may be a reasonably good place. And I also think some settling down of interest rates probably helps a little bit too, just in terms of the volatility.
Things have stabilised in the past few days off the back of that softer data and that massive reset in energy prices. Some breaking news just moments ago on Broadcom and Apple expanding their pact through 2031, developing silicon products for Apple. This is Broadcom. The stock in the pre-market higher this morning in the pre-market on Broadcom by a few percentage points. We're up by, let's call it 4%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump will travel to Turkey for the NATO summit. The president is expected to press allies to increase defence spending to 5% of their respective GDPs. Trump is set to meet with Ukrainian President Volodymyr Zelensky Wednesday to discuss the ongoing war with Russia. NVIDIA's next-generation AI server reportedly facing delays of more than a year. A report finding setbacks in the construction of the printed circuit boards for the platform. The report sending shares of several Asian tech stocks lower. NVIDIA has not yet responded to requests for comment. FIFA cleared US star Folarin Balogun to play in tonight's World Cup match against Belgium following a personal appeal by President Donald Trump. Balogun received a red card for a foul against Bosnia and Herzegovina, which normally leads to an ejection and a one-match suspension. FIFA removed the automatic ban, putting Balogun on probation for a year. And that is your Bloomberg Brief. John.
Bonnie, thank you. I've said it a few times already this morning. If you're just tuning in, here's my take. For whatever it's worth, it was never a red card. I'm pleased it's gone. I'm pleased the guy gets to play. The optics around it, super, super messy, though. Every time you get a red card in the knock-up stages, now you're going to get countries pursuing FIFA to overturn it. They're going to have to figure this out. But I'm happy he gets to play. That's the latest on FIFA this morning, which it turns out, and I've repeated this through the morning as well, is the most read story on the Bloomberg this morning, which is unreal. Up next on the programme, the Morning Calls Plus, we'll catch up with Tom O'Malley of Barclays as the memory supply crunch creates opportunities. That conversation is up next, live from New York City this morning. Good morning.
When people talk about equity markets, they talk about the fundamentals, they talk about earnings, and yes, that's all been pretty good, and also the economic backdrop has been robust. When stocks have been going up, particularly in the tech space and in the semi space, it's driving more buying in that, from a technical aspect, and if that goes into reverse, we could see that spiral downwards as well.
That was Alex Altmann of Barclays joining the programme a little bit earlier on this morning on the tech trade, some of the leverage building up in South Korea. We'll talk more about that in just a moment. Equity futures this morning going into the cash open 1 hour and 15 minutes away, positive by 0.5% on the S&P, on the Nasdaq 100 up by 1.26. On the Russell, some small relative underperformance there. We're positive by just about 0.2%. Into the bond market, that reset in yields and rates really stabilised that rate debate over at the Federal Reserve following that softer than expected print on jobs on Thursday. The 2-year down another 3 basis points this morning, 4.1%, 10s at 4.45. Not harming that story, the crude story, energy, speaking of resets, from triple digits to the 60s on WTI, 68 this morning, Brent crude at 72 and down a few tenths of 1% on the session. Let's get you some morning calls. That's the price action. First up, Bank of America lifting its price target on IBM to 330, seeing additional long-term upside from quantum computing. Your second call from Raymond James downgrading Delta Airlines to outperform, saying its recent rally has reduced its near-term valuation upside. And your third and final call comes from Cantor, raising its price target on Eli Lilly to 1350, saying the biopharma sector is a rotation beneficiary from AI names. That name is down this morning, incidentally, by about 0.6%. Elsewhere, tech stocks gaining this morning as investors await the massive ADR listing from South Korea's SK Hynix.
People feel like any exposure they can get to the AI trade still is going to work. We're actually seeing retail investors in Korea rush in to names like SK Hynix, while we see sort of institutional investors mainly flow out. And that is generally not a sign of a company that is super well priced and likely to continue to make a lot of more money for investors.
The memory giant looking to raise $28 billion ahead of his expected US trading debut this Friday. Tom O'Malley of Barclays writing, memory remains one of the most compelling opportunities that is not yet fully reflected in the stocks. Tom joins us now for more. Tom, good morning.
Thanks for having me.
I have to say, you've been tracking the programme this morning. That line there seems slightly contrarian, given what we've heard so far this morning. So give me the bull case right now for these names, even after they've had a massive run-up through the year.
Memory stocks look very different than they did historically, and that's largely because of the contracts that they're signing with their big customers. You traditionally saw very cyclical stocks, one-year deals, quarterly price renegotiations, but now you're moving towards 3-year, 5-year deals where you have visibility and security on both gross margins and the trajectory of these companies.
Does that help them build out capacity in this moment, in this cycle, without the boom-bust that we've seen previously?
The difference is that we came out of a post-pandemic world where we didn't have enough capacity, and you ran into this AI ecosystem just accelerating at an unprecedented pace. And so the catch-up is what we're doing right now. We're trying to build more and more capacity, and the supply-demand imbalance that we're seeing is something that's not going to get solved until the beginning of 2028.
Do we see any of the behaviors that we've seen in other bottlenecks, such as over-ordering and or concerns about getting enough capacity, so making a willingness to go out further? Because in other historic sort of commodity-like places, you get longer-term contracts, but the minute the market changes, those contracts also get changed. So is there any concern that you have about that at all?
These stocks are still cyclical, but the idea here is that there's longevity and there's visibility, and that's what's different. Where in traditional cyclical markets, you'd see the boom-bust cycle happen in a very short period of time. 6 months from now, you could be in a very different world than you are in today. But if you look at where memory is today, you have much longer line of sight. And that's what's changed here, and that's what's different and what people are willing to pay for.
Is that also a consequence of the fact that this is not so much about consumer electronics, which memory very often was, and is much more about the larger picture that's going on in an area where there just isn't, you don't have to worry quite as much about the capacity expansion as you did when it was a consumer-linked product?
I think it's a great point. I think if you look historically, where was the biggest percentage of bits going for these memory producers? It was to PCs and it was to smartphones. And those are inherently cyclical industries. If you look at where those bits are going now, it's to the data center. And data center is a differentiator when it comes to memory. Memory matters for how performance in data centers essentially works. So when you look at 3-5 years from now, you're going to see hyperscalers iterating with their accelerator products, and that's largely a function of the memory that's associated with them. So very different world that we're living in versus previous.
So that's the bull case. That's why these names are up by more than 200%. Now let's get to why people are talking about something else. Meta. Meta all of a sudden has excess capacity that it wants to sell. And people are looking at that move and saying, you know what, maybe things are starting to change. We go from constraints to excess. That's a change in language. Why is it not a shift in the narrative for you?
I think it's a competitor problem and not specifically an industry problem. If you look at Google, Google went to XAI and recently secured capacity from them as well. So you would argue that Google is in a position similar to Meta in terms of competing for the AI ecosystem, competing for dominance there, but they're kind of taking the opposite approach. We need more compute now. We can't get enough. So I think we should be differentiating perhaps between efforts from these large hyperscalers, and guys who want more compute perhaps are having a little more success than guys who are looking to perhaps get others.
Can we look to Signal as well? Meta rallied off the back of that story from our reporting last week. Some people look at that and say, you know what, there's this moment here that you need to pay attention to. They're being given the green light to be more disciplined about spending by the stock market. Why wouldn't others follow? How do you respond to that?
I think that we're still in the early innings of a long investment cycle. And I think if you hear the chip companies, if you listen to the way that they're talking about 2-3 years and the conversations that they're having with hyperscalers, this investment cycle isn't slowing. I would expect strong forecasts from the hyperscalers on CapEx. Obviously, it's something to be wary of when you see a slowdown in spending and perhaps stocks rallying off of that. I don't think that that's the beat of the drum here. I think that you're going to continue to see more investment going forward.
One of the questions that I had when I saw that announcement was, to your point, is this a specific Meta issue versus an issue of capacity overall? And I know that Meta certainly has had its history of making decisions to go one way with CapEx and then reversing those. Is this because they don't want to develop their own large language model? What do you attribute this to specifically for them?
From a chip-specific perspective, they have been behind in terms of developing their own custom silicon. So in the semi world, we started with general-purpose silicon with NVIDIA, and now we're moving more towards custom silicon with each one of these hyperscalers. And I think that you've seen Meta struggle to get a chip that's working in volume, and I think that's part of the reason why their spending plans may look a little bit different. If you look at Google, and then if you look at Amazon with the TPU, you've effectively seen, and Trainium, you've seen their ability to have success there far outweigh what you've seen with others. And so maybe Meta is a little bit more disciplined on spending because either A, they need to rely on someone else, or B, it's just taking longer for them to get the silicon that they needed to get up and running.
It's a really interesting point because I think that that's the differentiation that we don't see very much when you look at different both reports and when headlines come out and algorithms go chasing the headlines. There is a sort of lack of understanding, especially for those of us who are more generalized, exactly what that means because all compute is not apparently the same. So I think trying to get that understanding is very helpful from an investor standpoint.
There's just some nuance here where everyone is going to try to have their own piece of silicon eventually, and they're all at different parts of their journey to develop that silicon. Guys further along that are getting better ROI are going to double down, and I think this is my point on Google. And guys who are a bit behind may have different decisions on spend. I think in the end, you're going to see success stories and failures, and I think we're watching that play out right now.
What I hear from you is the runway is longer than people think. The runway for investment. Do you see capital markets providing the capital that these companies need for that runway to be elongated?
I think that's one of the three big risks that I think about in semiconductors. One is capacity from a wafer perspective. Two is memories, which is why I'm talking about why those stocks are still interesting. And three is just capital allocation and where are we going to get these additional dollars from. You do need to see more return from the labs in order to get these semi names continuing to work. You are reaching a point where these hyperscalers are spending more and more dollars. You've seen them access the equity markets and the debt markets. I think this is also something to pay attention to when you start progressing past 50% of your free cash flow to 100% of your free cash flow, then you blink an eye. But again, I do think you're starting to see that, and I think that's favorable for these chip names.
Things are changing quickly, Tom. It's good to catch up. Thank you, sir.
Thank you very much.
Tom O'Malley of Barclays on the bull case for this particular part of the equity market on a morning when so many people are talking about a shift, a rotation away from the beneficiaries of CapEx, the chip players, to some of the big spenders, the hyperscalers, so far this morning. Where do you stand on things, Sarah? How long is that runway from your perspective? Capital markets are long for the ride here still.
Well, so one of the questions I also have is that just thinking about that shift from consumer to data center, how big of an order of magnitude is that? Because if consumer took up 5 chips and a data center takes up 20, it's not just a question of cyclicality, it's also a question of size. And then you have to resize. And then I could see that timing and that pricing continue to work. I think the concerns that people have is when you're over-earning in a commodity business, that people worry that over-earning is going to slow down. So I think that is what all of us are trying to get our hands around.
The tech trade doing okay this morning. NASDAQ futures up by more than 1%. Equity futures on the S&P 500 into the opening about an hour and 5 minutes away, positive by a few tenths of 1%. Coming up next on the programme, we'll catch up with Veronica Clark of Citi. Still expecting rate cuts from the Federal Reserve this year, not 1 but 2. Plus, Yahara has your morning movers. Broadcom announcing it will develop and supply a range of custom silicon products for Apple, expanding their partnership. Broadcom up in a pre-market by 4% so far this morning. From New York City, you're watching Bloomberg TV. Stocks positive this morning by 0.4 on the S&P. On the NASDAQ, some outperformance on the tech side of things. We're up by more than 1 full percentage point on the NASDAQ 100, 1 hour away from the opening bout. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. News out just moments ago that Broadcom is expanding its relationship with Apple, and that is sending shares up 4.5% in the pre-market. Broadcom will develop custom silicon for future Apple products, with that agreement now running through 2031. It's an extension of a long-standing relationship between the two companies, and it gives Broadcom years of visibility with one of its key partners. Sticking with at the chip names and memory stocks, they are rebounding after a rough sell-off last week as optimism builds ahead of two key events that will test this trade. We get Samsung earnings tomorrow and SK Hynix's U.S. listing on Friday. And I will also note that the chip stocks are putting up a pretty good fight against Mike Wilson's call. He has a note out this morning saying that he prefers hyperscalers over the semiconductor stocks as a rotation takes shape. And we end on SpaceX shares. They are also positive, up now 2.8% in the pre-market ahead of officially joining the NASDAQ 100 tomorrow. But the action starts today as funds that track the index will start buying SpaceX after the close today and will likely fund those purchases by trimming other NASDAQ 100 holdings. So setting us up for an interesting day of trading tomorrow. John?
Yahara, thank you. Difficult to keep up this morning. We've got another supply pact from Micron, this time with Ford. Micron and Ford signing a long-term memory supply pact. Micron say the pact to strengthen supply of memory and storage solutions for Ford. We'll get some more details on those headlines and bring you an update in a few minutes' time. Let's talk about the week ahead. Investors are waiting fresh economic data later this morning. The PMI due at 9:45, the ISM at 10 a.m. Eastern Time. Mike McKay has a preview of that and a Fed minutes later in the week. Mike, good morning.
Good morning, John. Largely, those two data points are going to be what makes the week going to be a little boring for most people on Wall Street in terms of the economy. I think Annmarie and Lisa taking off this week and leaving you alone, they picked a good week. It's not going to be too busy. We do get ISM today, and the services industry is kind of one of the scenes of inflation lately. So there'll be some interest in the prices paid numbers there. Tuesday, May trade. Wednesday is those Fed minutes, and there's going to be a lot of questions about whether Kevin Warsh is going to shorten the minutes, change the format, or anything like that. So that's something to look forward to. Then Thursday claims Williams and Logan are speaking. And Friday, there's nothing on the calendar. So if the USA wins tonight, that's their next game, and we can all talk about soccer all day long on Friday. There is some question also about whether Kevin Warsh has talked Fed officials into speaking less. We only have 3 Fed speakers this week. I took a look at the last 5 years of Fed speak in the week after July 4th, and there has been a trend toward fewer speakers. So it may not be Kevin Warsh, it may just be the time of the year. We do get next week the Humphrey Hawkins testimony from Kevin Warsh, so that'll be a lot more Fed speak that people have to pay attention to.
So, Mike, what we've heard from Kevin Warsh, and I'm with you, it probably tells you more about beach season than anything else. But what we heard from Kevin Warsh more recently is ultimately don't speak unless you've got something to say. Next week's difficult because you kind of have to speak. Got to do your semi-annual testimony. So what can we expect next week?
I think it'll be very similar to what we saw in terms of his Fed press conference. He's going to be able to tell members of Congress there's a task force for that and talk about where the economy is. The latest data, he'll get CPI the morning of his testimony. But beyond that, no forward guidance is going to be his effort out there. We'll see what other topics members of Congress have on their minds, perhaps some regulatory issues, that sort of thing.
You got anything to say about the red card, Mike? Just to throw it out there?
You know,
mentioned it.
I was going to say that the president was wrong to get involved, et cetera, and then I saw that there is precedent with Ronaldo. And if they can do that for Ronaldo, they can do it for Balogun as well.
Why not, Mike?
Why not?
Mike, thank you, buddy. Appreciate the update. Veronica Clark of Citi with this to say on the Federal Reserve, writing a persistently low hiring environment will result in more obviously softer labour market data later in the year. We continue to think rate cuts are much more likely than hikes and pencil in cuts again starting in October. Veronica joins us now for more. Veronica, good morning.
Good morning.
OK, you're feeling better after the labour market report of Thursday.
Yeah.
On the rate cut call. What was in it that gives you the encouragement the next move is a cut, not a hike?
Yeah, I think, this is a very strange labour market. It's been that way for a while, this low hiring, low firing environment. So you really do have to look across many different data, many different months to, draw signals. And in that sense, yeah, the stronger payrolls data that we had the previous 3 months looked a bit like the outlier, and that looks much less the case now. Obviously, we had the softer June data, revisions lower. We did have a drop in the unemployment rate, but that's actually, I think, the most interesting part of that data. It came with this really large decline in labor force participation. It seems like maybe some statistical quirk. If you get that rebounding, then all of a sudden the unemployment rate later in the summer, I think, will look more like 4.6, 4.7. And that's not a very comfortable labor market.
Well, right now, 4.2. So I've got to ask the question, do you no longer think that's a good gauge of labour market balance?
No, I think it still is. I think the issue is that in this really low hiring environment, you tend to get the weaker data at the time of year you're supposed to hire a lot of people. And when you get a lot of new labor market entrants, and that's the summer, really July, August, September, that's what we've seen the last couple years. So, we know that we've had this big slowing in immigration. Labor supply is a lot less. We see that in the participation rate. But for the unemployment rate to then be stable at around 4.3, 4.2 does tell you that demand got worse along with supply. And it makes me worried for the summer when you're supposed to hire a lot of people.
And historically speaking, I think that some bad numbers in August were one of the reasons that we got the rate cuts that we got in September year, because people got worried, because that's the kind of weird data when also a lot of people are out of town, when people start to get concerned about bigger issues.
Yeah, it's always that July employment report that we get the first week of August. So we'll see what we get in a month. But yeah, it's that July employment report that has come out the couple days after the July FOMC meeting that then gets them worried about the labor market, and they start to cut in September. That's been the pattern the last few years.
If we look at the fact that oil prices have come down, and that was one of the issues that people were worried about, I know it's not the only component to inflation, obviously, but does that also, the combination of those two things, I definitely agree with the let's do nothing for a little while. I see where you're going with cuts. What are you looking for in that August, September timeframe that you would say would push you one way or the other?
Yeah. I mean, I think do need to see the obviously softer labor market data for them to get to cuts. But you can price out hikes even just with some of the inflation data. And I think we will see that over the summer. The elements of inflation that we have seen the effect of higher energy prices in things like airfares, those tend to come down later in the summer. I think they can come down even more. I think we will have a period of some pretty strange inflation data over the summer, where we've had this dynamic for most of this year where core CPI is running much weaker than core PCE. I think that could be really pronounced over the summer with those components like airfares. And then, interestingly, end of September, we're going to get revisions to core PCE inflation that make it seem like we'll be something 20, 30 basis points lower than where we are now. And that maybe is an important development before that October meeting.
So let's get to October. And I know it's difficult to forecast with any real degree of accuracy, but you've got the first cut in October. You've got unemployment where, and you've got inflation where?
Yeah, unemployment something around 4.7%. I think we could see that in the September number that comes out early October before that October meeting. Core CPI, I think, will be below 2.5%, something like 2.4. Core PCE still has the issue, right? There's still some of this, measurement dynamics.
To jump in, do you think that's necessary? It needs to be below 2.5 for them to consider cutting?
I don't know. I mean, it's not CPI, of course, that they target, but it would more just be that if CPI is obviously softer, some of these, alternative, PCE measures, the trimmed mean, the Cleveland Fed median, they're also trending lower. They're really only 20 to 40 basis points above their 2019 levels. All of those things together would make core PCE just really look like the outlier and make you question, especially with some of these big revisions late September, what's the right way to measure inflation?
Let's run with your 4.7. Sarah, if we got 4.7% unemployment, this might sound callous, but to the equity market, does it matter? How relevant is the labour market data to an equity market obsessed over the AI trade?
I think the equity market would think, oh, great, now maybe we're going to get some cuts and that's going to be good for me, as opposed to I'm worried about what that means for spending and I'm worried about what that means for the labor. I think you go back into that bad news.
Would you see it as a consequence of developments around technology?
I think that's still what people are trying to parse, because I think that we're still not exactly sure how much this is going to be a labor effective situation. We saw a big move towards getting rid of a bunch of software people and then a big move towards getting them all back. So I don't know that there is a consistent narrative that you can talk about with employment and AI right this minute. But I do think that to the extent that it makes it easier for the Fed and that inflation coming down and reasons to cut rates, I think the market gets much more excited about that than they get worried about the labor.
What do you think the relationship will be later this year between developments in technology and developments in the labour market?
Yeah, I mean, it's a question obviously we get all the time, and it's really hard to pick out if there is any kind of AI effect yet. There has been some larger layoffs in the information sector. Maybe it's one reason that hiring broadly is pretty low. But yeah, if you do get into later in the year, it is that tech AI related part of the economy where you do see any of the inflationary pressure. And for the Fed, yeah, you're going to have this trade-off then of, do we care about that kind of inflation, or do we care about the labor market? Higher rates is supposed to cool inflation via weighing on demand, and what kind of demand are you trying to control?
Veronica, good to see you. Veronica Clark of Citi, still looking for 2 cuts later this year?
Yep.
Starting in October and looking for unemployment to climb from 4.2 to 4.7. We could have, and I stress could because we don't know what we're going to get, but later this year, in the next several years, you could get this really strange development where profits are taking off because they're able to cut staff and cut labour, and you could have this situation where the labour market data just becomes almost irrelevant for what's happening on Wall Street and what happens with stocks. How sustainable that is, how far you can push that, I don't know, but that's what people have been looking for quite some time.
I think in the short term, people are always going to look at what does this mean for the stock market, and unless you start to get a number that's really like scary-er, like 5, and we're climbing to 6, then all of a sudden it's a very different story. But in the 4s, I just don't see that becoming as much of a problem as it is a potential pathway to higher.
Futures this morning, positive and higher by 0.4% on the S&P. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Micron and Ford both rising in pre-market trading after announcing a long-term strategic customer agreement. The deal coming in an effort to help strengthen the supply of memory and storage solutions supporting Ford's next-generation vehicle production. Broadcom shares are rising in the pre-market. The chipmaker announcing it will expand its partnership with Apple through 2031. Broadcom will also supply and develop a range of custom chips to be used in multiple generations of Apple products. In sports, Brazil is heading home from the World Cup in their earliest exit since 1990. Norwegian superstar Erling Haaland scored both his team's goals to send them to the quarterfinals for the first time in Norway's history. They'll be facing England, who defeated Mexico on home turf, overcoming a red card to win with 2 goals from Jude Bellingham and another strike from Harry Kane. And that is your Bloomberg brief. John.
Vonnie, thank you. That was a technical clinic from Haaland just yesterday afternoon. Up next on the programme, setting you up for the day and the week ahead. Plus, we'll catch up with Earl Davis of BMO, expecting more fuel for the Hawks. A different view on interest rates coming up next. From New York City, you're watching Bloomberg TV.
I expect the hyperscalers now to stabilize, and the semiconductor stocks are going to correct. That's a good development. That doesn't mean the capex cycle is over, but that ebbing and flowing between the two is a natural kind of governing factor, because you can't have this divergence continue. It's unstable. 30% correction in these stocks is, well within possibility.
That was Mike Wilson of Morgan Stanley. So think about what we've seen over the last year or so. Let's just take a snapshot of 2026 so far. CapEx intentions of a handful of companies have skyrocketed. These companies spending a lot of money. Some of those companies, those stocks, have really underperformed, the likes of Microsoft, the likes of Meta. Where's the money going? They're the stocks people have been interested in. The semis, the memory stocks, the likes of SK Hynix, the likes of Samsung, Micron. Those names have really, really taken off. Are we about to see a rotation back towards the spenders away from the CapEx beneficiaries? Is that what we're about to see? Ultimately, that's what Morgan Stanley's Mike Wilson is getting at. The catalyst for that maybe was Meta, selling excess capacity that might draw some questions about the sustainability of the increase that we're seeing in CapEx intentions. It's been a major debate for the programme through much of this morning. Sarah Hunt's weighed in on that debate a little bit earlier on this morning. Tom O'Malley took the different side of things, right? He told us there was more runway here. Where do you side on things after the debate we've had so far this morning?
Well, it's interesting because even when we talk about de-risking, we're not talking about taking all of that exposure off the table. It's really more about the size of that exposure, because it's hard to see that there is going to be a complete reversal. And it's interesting to me. As I was thinking about it during the break, I was also thinking, when semiconductors started to be involved in every single thing, every electronic thing, they're in your car, they're in this, they're in that, the extrapolation of memory to that wasn't something that we were all thinking about, to the extent that now we are thinking about it because it became a bottleneck. So then this really just becomes, is this such an expansion of how much memory you're going to need globally that, to his point, it's not the end of the cycle so much as, yes, it's going to be cyclical. Then it's a question, okay, so where are we? And where's pricing? And what does that mean? And I think that all of those things are difficult to divine. But in the end, I think that there's a larger expansion of need than maybe those of us who think about this in the historic sense, because memory was tied to much more personal stuff. It has to think about the expansion into the everything, which we're seeing with all electronics.
Which is why some of those names have really taken off so far this year. A few tests for some of those names later on this week. Let's get to the day and the week ahead is shaping up as follows. Later this morning, we get to deal with some data first. PMI and ISM services later on this morning. Tomorrow, the president attending the NATO summit. Look out for coverage from Annmarie. Plus, the first test really for the chip sector, Samsung earnings. Look out for that in the next 24 hours. And SpaceX, notable one, joining the NASDAQ 100. On Wednesday, we'll look at some Fed minutes together. On Thursday, another round of jobless claims. And on Friday, SK Hynix ADRs begin trading after raising close to $30 billion. They're tapping US equity markets later this week. Traders elsewhere pushing back rate hike bets after a weaker than expected payrolls print just last week. Earl Davis of BMO writing supply-side inflation impacts of the war that have yet to flow through will add to increasing hawkishness at the Federal Reserve. Earl joins us now for more. Earl, welcome, buddy. Good to catch up. Just build on that if you can. What kind of numbers are you anticipating through the summer?
Yeah, it's not through the summer. We think we'll be all right. So with the supply side, there's a couple things here. One is gas prices haven't gone down that much, only down about 20% since its peak, despite what WTI has done. But the supply side that we're talking about is, as people have mentioned previously, there's fertilizer. So you won't see that cost come through till the end of the year in food prices and the like. We also have chips, right? The helium and in regards to chips. Those price increases come with the issuance of the new phones, new computers for 2027. So we believe it's a sustained high core inflation, elevated core inflation, with pressure for inflation to go higher. So because of that, in addition to a number of other structural things, we believe 2027, we will set new U.S. highs on U.S. 10-year treasuries. So where this year we were in the range of 480 to 390, 2025 range, we think we'll be above 5% in 2027 for those reasons, inflation plus the competition for capital.
Oh, do you see the whole curve shifting higher off the back of that?
Yes, we do. And the reason why we do, it's the increased Fed credibility. With Fed Chairman Warsh coming in, it's not necessary. I don't believe he will raise rates this year, but they won't talk dovish. So not talking dovish in and of itself brings us to higher rates. So I think he'll let the market do the work for the Fed, which means your 2-year bonds stay above 4% and possibly go higher. But we will see the U.S. 10-year treasuries. I believe there's a very strong possibility of 5% plus rates sustainable in 2027.
There was another dimension, another leg, pillar to the trade, Earl, that you mentioned, competition for capital. Just flesh that out for us a little bit more.
I think it's the most important leg, and people don't talk about this. People don't look under the hood of what drives rates. So let's look at 10-year yields. The basic thing is supply and demand. So your supply of treasuries versus your demand for treasuries. Let's assume supply stays stable. Your demand for treasuries is going to be significantly less for 3 reasons. One is the competition for capital. So when SpaceX comes in and issues $80 billion in equities plus an additional $25 billion in bonds, that's $105 billion that it will not be invested in treasuries. We expect OpenAI and Anthropic to come out. That is additional money that won't go to treasuries. There's Meta, who will issue more bonds, probably in your 20 to 30 billion range, and the possibility of Microsoft. We're talking hundreds of billions of dollars that could have potentially gone into treasuries are going into capital or growth producing areas. Let's add to that. With the Strait opening back up, you get these global international countries restocking their commodities. Again, how do they buy that? They use their savings. Their savings is treasuries. Again, less demand for treasuries. This geopolitical, the Venezuela, what's going on there? You see India, all the weather events, again, to rebuild buildings, that's treasuries. If you get peace in Ukraine, to rebuild Ukraine, you sell your savings, you go into the rebuild, treasuries. So there's a lot of structural tailwinds for higher levels. But these are slow-moving events, which we think will all culminate in 2027. So right now, we're actually small long treasuries because we believe we'll be fairly well contained for 2026. But any move below 435 U.S. treasuries, and as we get closer to the end of the year, we will start being aggressive sellers at those levels.
I just want to live in the end of the year just a little bit more with you, Earl. Let's say we get that repricing because of the competition for capital. So you've got yields on the risk-free component of the overall all-in yield pushing to, say, 5. Where have you got credit spreads? All-in yields will be higher, I've got that. But where are credit spreads in that world, that competition for capital?
So, great question. I'll start with ultimately, they're at these levels or maybe even slightly tighter because growth will still be good. The reason why I said ultimately, it will be volatile in between. The adjustment to higher treasuries will bring wider credit spreads. We will use that as a buying opportunity. Right now, we are overweight credit. Our strategy is to move to more liquid credit because of this volatility that we expect. So we want to be long, but we want to be long liquid product so that we have dry sand to go from investment grade to high yield when those spreads widen. Why do we think ultimately credit spreads will basically be where we are right now? Growth is still good, and growth is underpinned by deregulation. No one talks about the deregulation going on in the US. That is taking off so much friction off your small and medium-sized businesses, and these are the ones who produce jobs. So when I see headlines of AI and jobs and job losses, to me it's nothing. It's move on, carry on, because the large companies aren't your engine of job growth. And your small and medium-sized businesses will continue to underpin growth in the US. So we think it'll be a very interesting environment. There will be volatility in the adjustment to higher yields, but ultimately we believe it'll be very attractive. Perfect time to be an active manager like us. This is environments we thrive in, and we have been thriving, and we expect to continue to do so.
Strong pitch. Oh, good to see you. Clinic on fixed income, sir. Thank you. Earl Davis of BMO. We like someone with an opinion. Sarah, that's an opinion. 5% yields on 10s, competition for capital. How would the equity market respond to that?
It's a very interesting question, and I wonder a little bit about whether or not, if they do see any weakness or major weakness in that 10-year demand, if they start to change and shift down the curve a little bit and change the issuance and see if that, so that they don't have that, because that above 5% does seem to be one of those lines in the sand that make people nervous. When we start talking about 2027 going above 5%, I'm thinking that equities are not probably going to like that very much.
We're not far away right now, around 450 this morning, 446, yields down about 2 basis points. Sarah, it's good to see you. Lots to think about for the year ahead. Sarah Hunt there of Alpine, Saxon and Woods. The week just getting started. Coming up tomorrow, Julian Emmanuel of Evercore, Todd Mortensen of Baird. We'll catch up with Stuart Kaiser of Citi, Michelle Mayer of MasterCard. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.